All right.
Yeah, absolutely.
Rob, thank you so much. And hopefully we can reach out to you maybe at a different macro environment as well. Rob Rich, he's CEO of the Optical Foundry, joining us there. And our thanks to Nina Trentman, senior editor at Bloomberg News, the author of the CFO Briefing newsletter. You can find it at bloomberg.com/CFO Briefing. It comes out on Sunday and Rob will be in it.
Hey, I got my eye on the S&P 500 because we just bounced off the worst level of the day. We're close to our session lows, down 5.42% as we speak.
All right, coming up, another view from the C-suite. The vice chairman of Korn Ferry hearing, or what he's hearing from other C-suites. It's coming up.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Lows of the day right now on the S&P 500 index. 1 hour, 20 minutes to go until we wrap up the trading week. We've got the S&P 500 index right now plunging by 306 points, down 5.7%. The Dow is down more than 2,000 points right now. 2,098 on the Dow Jones Industrial Average. That represents a drop of 5.2%. Again, to put that in context, the S&P is down 5.7%. In the year-to-date column, the S&P is down 13.55%. NASDAQ right now down 5.7%, down 936 points on the NASDAQ Composite Index. The NASDAQ 100 Index down by 5.8%, and the 10-year 3.96%, the 2-year 3.63%. Gold is down 3% now at $3,021 the ounce. West Texas Intermediate crude is plunging 7.3%, $62.08 a barrel on WTI, and Bitcoin up 1.9%, 83,885. Bottom line here, the losses are continuing. S&P down by 5.8%. Wall Street banks are enduring another sharp sell-off after China retaliated against President Trump's tariffs with a 34% levy on U.S. goods. Morgan Stanley, Goldman Sachs, Citigroup, and J.P. Morgan Chase all lower. J.P. Morgan Chase will be reporting a week from today. That stock down 7.5%. Goldman down 8%. Morgan Stanley down 7.9%. Citigroup shares lower now by 7.8%. Recapping, S&P plunging 5.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. As you know, President Donald Trump has extended the deadline for ByteDance to divest TikTok's U.S. operations by 75 days to finalize a plan to keep the app running in the country. There was a deadline until tomorrow, but then the president came out today and extended that deadline. Well, Tim, now we're hearing from ByteDance.
Yeah, the company says it has been in discussion with the U.S. government. It confirms that it's been in discussions with the U.S. government about TikTok. This is from a statement on its website. A pact, though, has not been executed. There are key matters that need to be resolved, and any pact is subject to approval under Chinese law. Once again, this is just in the last couple of minutes coming from a statement on ByteDance's website.
All right, let's get back to the general market environment, business environment, global environment. We've talked about businesses pulling back on CapEx, slowing global growth here in the U.S. And elsewhere. Tariffs, a global trade war, a global market sell-off, not an easy macro environment. And on a day like this, it is easy, as we talked about earlier, to kind of skip over a U.S. jobs report that showed growth exceeding forecasts for the month of March. It was backward looking. So we wanted to get a good gut check on the U.S. macro environment, what he's hearing from companies in the C-suite about the labor market and more. Alan Guarino is back with us. He's vice chairman in the CEO and board services practice at the executive search firm Korn Ferry, joining us from the West Coast. Alan, nice to have you here on a week that's been a little hectic, to say the least. A lot coming at business leaders, a lot coming at the markets. What are you hearing from the business community about the macro environment?
Well, thanks, Carol. It's always great to come on with you and Tim. You know, what we're hearing is, you know, what we've been hearing other than the last 48 hours of what I think we would all categorize as shock to the system. And so let's just recap. So we had a big jobs number on one hand, then we had tariffs on the other in the last 48 hours. You know, someone could say a trade war, right? But we had a strong economy going into this, people would argue, and we had low unemployment. So I think the best thing to describe this is that, you know, if I were a CEO today, I'd feel like I was driving a race car with one foot on the gas and one foot on the brake.
Wow.
And I think what that means is that, you know, as much as we'd like to have really solid, smart predictions, I think it's a wait and see. And I think that wait and see is probably in the window of 90 days. Will, you know, U.S. labor be competitive? Should manufacturing be able to return in some measure to our shores? It's just early times right now.
Listen, one thing I want to get to, though, too, uncertainty, no doubt about it. You know, I'm looking at a market that is just getting worse, and we've got about an hour and 15 minutes to go, and we're looking at our major equity averages, Alan, at the lows of this session, something we haven't seen in a long time. S&P 500's down 6%. Dow Jones Industrial Average almost 2,200 points to the downside, down about 5.5%. NASDAQ 100 down almost 6%, down 1,100 points. You know, that does rattle businesses and leaders. Certainly if you're publicly held, you know, you look at your share price. What does this make you stop to, you know, do? What won't you do as a result of all of this?
So, Carol, honestly, you know, go back to Adam Smith. I think he said something to the effect that, you know, understanding history will empower you as to know what to do. Let's think back, sadly, to the pandemic. I think we had a 30% peak to trough market move within a very short period of time. The market came back. So CEOs don't usually run their businesses based on the stock market. Yes, they run their businesses based on creating the right earnings, trying to defend their multiples, but I don't think 30, 60, 90-day windows in terms of market reactions to clearly identified outside shocks is going to change that. You're going to have some CEOs, let's just say there's job dislocation in this market. I don't think there will be, but if there was, that means that if some company's cutting back, there's going to be a smart CEO who's going to step in and acquire that talent. Just like, quite frankly, people are going to over the next couple of months, if this market continues to, you know, trade lower, are going to step in and start taking on stock positions that they would have liked to take previously that they felt were overpriced. So with all of this, let's call it somewhat chaotic market activity, it doesn't short-term change the way CEOs run and make decisions, especially on hiring.
So at this point, you're not hearing from CEOs that they need to pull back on hiring. They need to start cutting their workforce because, look, we did get a great number this morning from the March payrolls report. It's backward looking, but if we start to see stress there, that could actually prompt the Fed to move rates lower. You're not hearing any of that from the folks you talk to?
We're not hearing anything right now. And I think it's because of the foot on the brake and the foot on the gas situation. If anyone says they have enough clarity to make those decisions right now, I would tell you that they know something that 99.9% of the rest of the world doesn't know. So I think we'll start hearing that in probably, I'm going to say 45 days, 60 days. And again, I think we'll hear it from both sides of the thinking here. Some that may want to cut and others may want to take advantage of the opportunity that this talent is in the market. But right now, there's nothing shocking happening in terms of employment.
Alan, I want to go back to something that you said about these tariff announcements being a shock to the system. Why was this so shocking to the folks you work with each and every day? It was clearly telegraphed by the president when he ran. He told our own editor-in-chief, John Micklethwait, that tariff is his favorite word in the English language. We knew he was going to do this. Why was it still so shocking to the markets and shocking to the executives?
Tim, everyone's asking that question today. It's a smart one. It's a shock not because of what he did. I think it's a shock because people were expecting it to be less significant in terms of scale. So in that, they had to process not the idea that we had tariffs. And I'm not going to comment on whether tariffs are a good idea, and I'm not an economist, and I don't think anyone knows how this plays out mathematically and in terms of actual market equilibrium. But I think the shock to the system was the scale. And there's shocks to the system frequently, and people get past it.
Hey, one of the things I wanted to ask you, and here we are again, just to remind everybody, since we're so focused on the market, you know, a second day of some extreme selling, S&P down about 5.6%, Dow down 5%, and the NASDAQ 100 also down 5.6%. Alan, the U.S. Labor Secretary earlier spoke to Bloomberg off of the jobs report. That was an upbeat one, and said that this wouldn't be the last positive jobs report under President Trump, and that companies are now investing billions of dollars in the economy. We're seeing the selling because there's nervousness because of the U.S. tariffs, a possible trade war, and then that leads to a U.S. slowdown and potentially a global slowdown. So the president has stressed all the money that will come back into the U.S. economy. Do you and leaders that you speak to kind of buy this idea that there will be lots of investment or more investment in the U.S., that we will see factories built, make things, create lots of jobs, that it will lead to an economic boom? I know what economists say and what history tells us, but what do leaders that you talk to say this? Do they buy this action and this expectation?
You know, I again, not hearing enough to say, wow, there's a big trend here. But what I do hear is, you know, there are places in this country where people could make a reasonable dollar per hour wage that wouldn't be egregious in terms of being competitive, and have a terrific quality of life. And certainly that's not necessarily in the big cities, but if we bring in a situation where free market of sorts starts to see some green shoots in terms of light manufacturing,
Right.
then yes, the answer is it could be. And by the way, there's another thing to remember. It's something that Korn Ferry does. It's this notion of upskilling. So, as these jobs materialize, if this particular strategy works, then we're going to have people right now that are in, let's say, lower order jobs that make less per hour, perhaps get some upskilling and be able to go into a light manufacturing opportunity where they could make more. All of this is still speculation.
Okay.
Each of us could argue both sides. I quite frankly don't have a particular bias here. I try to look at it as measured as possible.
20 seconds. Everybody's not screaming recession or stagflation or the end of globalization. Just quickly.
People are worried about stagflation.
Okay.
People are expecting, recession because we've been expecting recession for 20 years. So, and again, I think we talk about the market. If we look at the market today, I think if you look at the 2-year S&P today, it's still up 35% over those 2 years or so. It's a big number.
Yeah.
So, a lot of the money that's theoretically coming off of people's portfolios today is money that they've more than earned in returns. And again, if you don't sell today, you don't lose any money, right?
All right. Interesting and great perspective, and kind of gets us to where we want to go next, because we want to go back to the markets. Alan Guarino, thank you so much. Vice Chairman in the CEO and Board Services practice at Korn Ferry, joining us from the West Coast.
Look, he's right. Still up 42% from those October 2022 lows.
Perspective, right?
Yeah. When in doubt, zoom out.
Yeah.
When you're looking at the portfolio.
No, I mean, we talk about this all the time. Let's talk a little bit more about the markets, as we have, just to remind you of where we are. S&P 500 down 299 points, down 5.5%. The NASDAQ 100 also down 5.5%. It is a point drop of about 1,014 points. The Dow Jones Industrial Average down more than 2,000 points for a decline of about 5%. Let's get to Belly Lipschultz. He follows the markets. He's Bloomberg News equities reporter. He joins us in New York. Hey, Belly, good to have you here with us. General thoughts initially on this trade. Again, it's a second day of selling. I think we all kind of came into the office thinking, will we see a bit of a bounce today off of yesterday's selling? That's not what we got.
No, I think there was a lot of hope that yesterday would be the selling, to your point, and then we'd kind of rally or at least see green shoots going into the weekend. But when I've been talking to portfolio managers, folks at investment banks, the big concern has been China struck back. And what does that mean? And then Donald Trump came out saying that he's basically not going to renege on his current stance. So the big uncertainty, and part of the reason we're seeing a sell-off into the close, is do you want to be long stocks over the weekend if that's the positioning from the White House? And that's what we're waiting to hear from other countries that Donald Trump assigned tariffs to. Obviously, a lot can change hour by hour, and 48 hours over the course of a weekend is a long time, is a lifetime, seemingly in this ongoing trade war. But there's a lot of uncertainty. And when I talk to people, as your last guest mentioned, the stock market was basically priced for perfection and for the economy to continue to hum along and interest rates to fall because we have such a strong economic backdrop. And right now that's being questioned just because if this current stance continues to play out, where does that leave us in 2025 and 2026?
We saw a little bit of buying earlier in the session, Bailey, when we got the news that the president said that Vietnam is willing to eliminate tariffs on U.S. goods. He put this on True Social a little earlier in the day. Then we went back to our lows of the session just moments ago. But did this indicate to you, and do you think it indicated to traders that, hey, this is an opening salvo indeed, and that these numbers could change if countries come to the table?
I think that last part, though, Tim, is the big thing. If countries come to the table and meet Donald Trump how he wants to be met, when you look at the messaging from people in Donald Trump's camp, he's been waiting and talking about bringing kind of global trade back to an even playing field, in his view, for decades. So the thought that one phone call with a leader of a country is going to completely change his stance, at least from my conversations, is a bit kind of wishful thinking, if you will. Obviously, we've seen some of the companies that are exposed to Vietnam through their supply chain rallying on that Truth Social post. But again, just one comment in kind of this grand scheme, when you're looking at the tariffs that are allegedly going to be levied, there's still a lot of questions that need to be answered. And there still are a number of countries that would need to show up to the table.
You know, Bailey, I don't have to tell you this. You know this better than all of us. There's so many different metrics that you can look within the financial markets to kind of get a gauge of the health of a move, whether it's to the upside or the downside. There's lots of different metrics. We've talked about the VIX. Once again, we're looking at it at about 43. We've been as high as 45 today. I'm also thinking about IPOs, and we had kind of a rash of IPOs saying, nope, not going to enter this market. Fintech giant Klarna Group, ticket platform StubHub Holdings, pausing plans for their initial public offerings, according to those familiar with it. You know, that's not a sign of a healthy market.
No, but the big thing is, and again, I've been on the phone with a number of heads of these investment banks, is, as one put it, would you go for a run in a hurricane? No. And that's kind of the big thing with these deals, is if you wanted to market an IPO to new investors next week, you need to have a pretty darn good company and a pretty attractive valuation to get them to want to do the work. Because when you talk to public investors, they're worried about their current portfolio and how the ebbs and flows of this trade war could impact it. So would you want to meet with a StubHub, to your point, Klarna, a number of other companies we've been reporting that are tabling those discussions for now? You do not. And simply from a company perspective as well, if your best comparison is down 20% in the last 2 days, you need to see some kind of valuation expectation, and that watermark has to move for you to kind of at least be comfortable bringing a deal to market. And that's something we've been tracking and are going to continue to track. And at least from the conversations I've been having with bankers, the expectation is, hey, we're not going to see a company on the road meeting with investors, best case, until after Easter, if not closer to the end of the month, unless things change drastically. And we do have an expectation that that is going to be how it will be kept from the White House.
Bailey, let's take a look at some stocks on the move this week. Bailey Lipschultz is Bloomberg News equities reporter. Bailey, got a couple minutes on this. What's on your radar today?
Yes, you mentioned kind of the response from Donald Trump about Vietnam. We did see the likes of a Nike, on the shoemaker, on Lululemon rebounding today, actually trading in the green, a handful of the few stocks that are trading higher really on most folks' radars. So this is signaling some optimism that maybe their supply chains that they intentionally had diversified away from China are actually going to be playing out in their favor. So again, a little bit of bottom feeding, but keeping things full perspective, these are companies that for the most part were deep in the red yesterday and now are only marginally higher. So again, Nike, one of your best performers in the S&P 500, along with some of those other apparel athleisure companies, but still a lot of questions around some of those other countries that they source goods from.
NVIDIA having another tough day, though.
Tough day for NVIDIA. One of the things we track is retail buying, and I've seen an overwhelming amount of buying on the Fidelity platform from what we've heard from the folks over at JP Morgan. So buying that dip, but this is a company that is so heavily predicated on being the driver of the market. So if investors are de-risking or de-leveraging, maybe even just taking some chips off the table after what's been a tremendous, really 3-year stretch, that's why we're seeing NVIDIA, again, being one of the many Mag 7 names helping drag some of these big benchmarks lower.
All right, finally, just 30 seconds on Tesla. What's going on?
We saw a big rally after the election, down 10%, Tim. Fundamentally, in theory, should be somewhat benefiting from supply chain tariffs, I think. But the big thing is such a big run up and continuing to see concern around Elon Musk, the future with the government, with the company, and obviously another one of the many companies that, at least on a typical earnings multiple, is very highly valued relative to even the Mag 7 at like 4 times. So seeing that company taking on the chin as well.
Yeah, down about 50% from that mid-December high. So ouch. Bailey, thank you so much. So appreciate it. That is Bloomberg News equities reporter Bailey Lipschultz joining us here with some of the movers on this Friday. There are a lot of movers to the downside.
There are. And hey, if you're sticking with us on Bloomberg Radio, on YouTube, on Bloomberg Originals, we've got the chief strategist who foresaw the tariff shock and says the worst is yet to come. Yes, even after this week, we're going significantly lower by the end of year. That's next on Bloomberg Business Week Daily. The close is next on TV.
is CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. The Dow continues to tumble off more than 2,000 points at this hour as the trade war escalates. China announced retaliatory tariffs. Business contributor J.D. Durkin says that will be very painful for some American companies.
So when you consider how many companies have revenue exposure to other parts of the world, especially China, right? You're talking tremendous downward pressure and really a loss of trillions of dollars for companies like Apple, Tesla, Qualcomm, even Caterpillar, a great American brand out of Texas that makes so much of its revenue up to 10% out of China. All of that uncertainty is going to weigh on investor sentiment.
American farmers, too, will feel the impact. China is halting chicken imports from 5 of the biggest agriculture exporters in the U.S. CBS's Weijia Jiang at the White House, where they're standing firm.
President Trump is not going to back down from this idea that he wants everything to be made in America. He really wants to be the architect of a new boom in manufacturing for the country.
President Trump's giving TikTok another reprieve while his administration brokers a deal to bring it under American ownership. Linda Kenyon has that.
President Trump has signed an executive order to give TikTok another 75 days to operate in the U.S. In a post on Truth Social, the president said there has been progress in negotiating a deal with the social media platform, but more time is needed to finalize it. Citing national security concerns, Congress had mandated TikTok be divested from Chinese ownership by January 19th, or it would have been barred in the U.S. But since then, it has been operating on a presidential extension, which was to have run out this weekend.
Democrats say they're outraged by President Trump's firing of the top National Security Council official and others. Christopher Cruz has that.
In addition to leading the NSA, Air Force General Timothy Hawk was also the head of Cyber Command. A senior intelligence official and a source familiar with the circumstances tells CBS News right-wing personality and conspiracy theorist Laura Loomer played a role in the firing. CBS News has also learned that others in the president's circle also pushed for Hawk's ouster. Sources say the 56-year-old four-star general's perceived close ties to the former chairman of the Joint Chiefs of Staff, Mark Milley, whom Trump despises, worked against him. Christopher Cruz, CBS News, Washington.
More dangerous weather is expected in the nation's midsection, including what some forecasters are calling potentially catastrophic rains. The Associated Press is reporting close to half of all local National Weather Service offices have a 20% vacancy rate, twice what it was 10 years ago. On Wall Street again, the Dow off 2,000. This is CBS News. Comedian John Oliver is being sued over an episode of his HBO show Last Week Tonight. CBS's Steve Kathan has that.
It was a show about Medicaid.
There is one last massive flaw with our Medicaid system. Now,
it showed clips of Dr. Brian Mobley. He alleges in a lawsuit they were taken out of context to make him the face of a predatory system. He says the episode that aired last year wrongfully implied that he had illegally denied services to patients. The segment centered on a severely disabled patient in Iowa whose Medicaid care had been cut off. A representative for Last Week Tonight called the lawsuit meritless. Steve Kathan, CBS News.
British police have charged comedian Russell Brand with rape and sexual assault against 4 women. The alleged offenses took place between 1999 and 2005. The investigation was sparked by a TV documentary. Brand denied the allegations, saying his relations were always consensual. I'm Cammie McCormick, CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenevec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody, a good afternoon to you on this Friday, April 4th. And
Well, excuse me?
I know, I like to be friendly.
Okay.
What can I say? I like to be nice, cordial. It's a rough day. It's certainly, as you say, we like to say there's two sides to the trade. So if you're short this market, you might be pretty happy, but a lot of investors who are long are not. We've got about 55 minutes to go until we wrap up the trade on this Friday and also for the week. It's been a rough one, especially the last 2 days following President Trump's tariff announcements. And right now we're pretty much hovering near our worst levels of the session, almost 6% lower on the NASDAQ 100.
Yeah, we'll have more from Charlie Pellet in just a minute. Suffice it to say that in the S&P 500, there are only 15 stocks in the green, 488 to the downside.
I'm afraid to look at my gainers when we head over to our TV.
Because I would just don't look at your 401k. You'll be fine with your gainers.
Nope.
Don't open the 401k. We've got the chief strategist, though, who foresaw the tariff shock and says the worst is yet to come. We're going to that we're going significantly lower by the end of the year. He's standing by. We're going to get to him in just a minute.
Forecast. You may have already read it on the Bloomberg, but it may shock you a little bit. We're also going to get into how Wall Street trading desks have been stunned by a once-in-a-century tariff shock. So we're going to talk about the Treasury trade, so important as well. I know we've talked a lot about the equity trade, but you got to watch what's going on in Treasuries too.
All right. And even though we've gotten the tariffs, the chaos, the uncertainty is far from over, at least according to Sean Donnan.
Aren't you glad you tuned in, everybody?
We were going to have, we were going to have pets.
We were going to talk about pets.
We were going to have pets.
We're not talking about pets today. All right, first up, let's get to the trade, folks, because we're bouncing around the bottoms here. Let's head on over to Charlie Pellet.
Thank you very much. We got pets for you. One big bear right now with the Dow, the S&P, NASDAQ. They're all in the red, looking at a drop of almost 2,100 points on the Dow Jones Industrial Average. Yes, you heard it right. I'll say it again right now. The Dow is down 2,073, drop there of 5.1%, with the S&P 500 index down 307 points, a drop there of 5.7%, extending the year-to-date loss to 13.4%. NASDAQ, the composite index, down 5.6%, with a 10-year 3.98%, the 2-year 3.67%. The sell-off deepening, bonds rose, oil at a 4-year low, as Fed Chair Jay Powell signaled the damage of a trade war will be bigger than anticipated. Spot gold is lower by $90 the ounce, down 2.9%, $3,025 on the precious metal. West Texas Intermediate crude down 6.9%, $62.35 a barrel. Bitcoin up 2%, $83,997 on Bitcoin. Stephanie Roth is chief economist at Wolfe Research. She says markets today are more focused on tariffs than they are on the jobs report.
These tariffs are so big, they are going to be very damaging to the consumer. And by the way, businesses have no idea how to invest in this environment. So you're going to see a sudden shock. I would look at this as a shock to the economy as opposed to something that's more domestically driven, in which case then those things tend to take a long time to work their way through the data. So the fact that today's data was strong doesn't really matter a whole lot in the context of everything else going on.
Stephanie Roth of Wolfe Research interviewed this morning on Bloomberg Surveillance. The trade fight weighed hard on shares of industrials and materials companies, including such firms as Stanley Black & Decker, the tool company. Also today we had Caterpillar down 5.6%. Stanley, by the way, down 4.6%. Harley Davidson now down 1.1%. And Whirlpool lower by 2.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Well, just after the U.S. election, when Wall Street was all in on the prospects of a business-friendly President Trump, Peter Berezin was sounding the alarm. He and his team at the research shop BCA predicted that broad-based unilateral tariffs were coming and that the new administration's proposals would go well beyond what had been implemented in Trump's first term. He was right, and now he says we've got a long way to go, lower before the end of the year. In other words, the worst is yet to come. Peter Berezin is chief global investment strategist at BCA Research. Their clients manage some $34 trillion. He's featured in one of the most read stories on the Bloomberg in the last 8 hours. He's based in Montreal, Canada. Peter, welcome to the program. You've got a 44.50 call on the S&P 500. We're at about basically 5,100 right now, so roughly 15% decline from where we are. Why are you so bearish?
I don't think the stock market has yet fully priced in a recession. I mean, keep in mind that up until a couple of days ago, the 493 S&P companies that are not the Magnificent Seven were still actually up slightly for the year, and these are generally cyclical companies that one would expect to go down in a recessionary scenario. So we're starting to see that being priced in, but we're not there yet. To get down to 44.50, which is my target, you don't need to make any wild assumptions. All you need to assume is that the forward P multiple drops to 18 and the earnings estimates fall by 10 percentage points. That's not crazy at all. On average, between 2015 and 2019, the P multiple was 16.8. And I'm talking about 18 in a recessionary scenario. So if anything, my target, even though going into this year, it was 1,500 points below the nearest person, might actually turn out to be a little bit too bullish.
Could we even go lower than that?
We certainly could go lower than that. I think it would require a deep recession, but we could get a deep recession if policy continues to be very unfavorable. And I'm not just talking about tariff policy. We also have kind of this discussion of the Mar-a-Lago Accord, this idea that perhaps holders of treasury bills will be forced to roll their money over into low-yielding long-term bonds. I mean, this is crazy, right? The treasury market is the ultimate risk-free asset. If we undermine the sanctity of the treasury market, then we're looking at a worse financial crisis than what occurred in 2008.
This was supposed to be the year.
Wait, you said we could. Sorry, Tim.
Hey, go ahead.
I remember living through 2008. I know you did too. And I just remember,
you talking to me?
Yeah, I'm talking
did.
to you. I mean, Peter, we thought the financial market system globally was coming down. I remember not going to bed because headlines were crossing and it was like which Wall Street firm was being bought by whom and which one wasn't going to make it and so on and so forth and what the government was going to do. Say that again so that we understand kind of the heft of what you are saying.
The fact that the dollar is weakening now is very, very unnerving because the dollar is supposed to be a risk-off currency. You buy treasuries when everything is going to hell, and that requires more dollars, and that pushes up the value of the dollar. The fact that the dollar is weakening now is telling you that increasingly investors are losing confidence in the U.S. financial markets. And, you know, President Trump wants a lower trade deficit. The counter, the mirror image of a trade deficit is a capital account surplus. Yeah, if foreigners decide that they don't want to hold U.S. assets anymore, that's going to drive down the value of the dollar. That'll make imports more expensive, make exports cheaper. That'll result in a lower trade deficit. But we're talking about something that will also entail a huge decline in stock prices and probably a financial crisis.
So not exactly making America great again.
Not quite, no.
You know, it raises the question about how much damage can be done before you believe that Trump will reverse his policies, if that is something you believe.
Well, I think for one thing, we've already sort of passed the event horizon. I think at this point, it's going to be very difficult to avoid a recession just based on everything that's already happened. The economy wasn't that strong going into the latest escalation of the trade war. In February, real wage and salary income was only up 1% year over year. The CPI swap market is telling us that these tariffs could push inflation to well over 3%. We're potentially looking at negative income growth. That's going to be very difficult to maintain without the economy weakening significantly and spending drying up. So I think the outlook is quite worrying at this point, and it's probably too late to avoid recession. And I don't think that Trump is willing to reverse course anyway. He's been very, very clear, really for like 30 years, about how he wants to build this protectionist wall around the US. I don't understand where this groupthink came from, where people were just saying, oh, it's going to be a negotiating ploy. It's not a negotiating ploy. He wants something that resembles autarky.
Okay.
We're going to pick up on that, but we got to do a headline.
There's a headline crossing the Bloomberg terminal. I'm going to work it into a question here. eToro is said to delay its IPO roadshow amid market volatility. Put that on the list of companies that we've heard from today or have been reported on putting their IPOs on hold. StubHub, Klarna, AdTech Group, MNTN, Insure, Integrity Specialty Holdings, Chime as well. Are you concerned that we're seeing financial conditions tighten too much right now? We could start to see some sort of panic or freeze?
Yeah, we estimate that easing financial conditions last year, mainly because of rising stock prices, added around 0.5 percentage point to growth. The fact that financial conditions have tightened, mainly because stock prices have fallen, credit spreads have widened, is based on kind of a very back of the envelope calculation, will shave around 0.5 percentage points from growth. And that's not huge, but the risk is that you get kind of in this feedback loop situation where stocks go down. That means people feel less wealthy. That means they spend less. So there's less sales, less profits, and even lower stock prices. That's what we often see during recessions. I think that's what we're starting to see now.
You know, I'm looking at something I think you either said or shared with Market Watch, and this was around late March 21st, and that even though you had this outlook for the S&P 500 this year of 4450 by the end of the year, and I think when you compared it to anybody else, it was the lowest on the street, you did have 5 scenarios that could boost stocks this year. And you talk about the president, you know, walking back much of his tariff agenda, kind of caving to pressure from the market, and a few other things. Do you still believe that there are scenarios where the market could actually rally?
There's certainly scenarios, and I wouldn't be surprised if over the weekend there's some comforting words from the Trump administration, but that's not my base case. I think that probably the trade war gets worse rather than better, because Donald Trump kind of had this, well, I'd almost say like naive idea in his mind that he's going to raise tariffs, and that's going to force other countries to reduce their tariffs. Well, there's two flaws with that argument. The first flaw is that most rich countries don't actually have very large tariffs against the US and don't really have very large non-tariff barriers against the US. I mean, they have regulations. All countries have regulations, but they're not specifically targeted at US companies for the most part. There's going to be exceptions, of course. So there's not a lot that other countries can do anyway. And the second thing, which is more politically relevant, we've seen, this is certainly true here in Canada, that retaliation is politically popular. Donald Trump has single-handedly resurrected the Liberal Party, which was heading for a huge defeat in the elections. And so people are saying, well, wait a second, if we can get more votes by retaliating, we'll retaliate. And so we're not going to get countries acquiescing to Donald Trump's demands. We're going to get retaliation, and that could very well spark another round of tariffs.
You know, one of the things I also wonder is that, is it possible that, this, I guess what I'm thinking about is what you said before, autarky. And that is the idea that, right, the US produces everything that we need within our borders. Is that really, you think, the goal of President Trump? Because I think that's one of the things that we've tried to figure out with the tariffs, is that what's really his end game? What's really his mission here? But do you believe that his mission is that the U.S. is kind of self-sufficient in providing everything it needs for its citizens within its borders, and then cut down trade?
I think Donald Trump sees trade as a zero-sum game, meaning that if one country is running a trade surplus with the U.S., then somehow that country is exploiting the U.S., ripping the U.S. off, as he likes to say. He doesn't see trade as something that can lift all boats, which is the way most economists see trade, nor does he kind of realize that the reason the U.S. has this trade deficit is because the U.S. has been a very good place in which to invest. Rather than buying U.S. goods, foreigners have been buying NVIDIA stock or treasuries. That has been a vote of confidence in the financial system. And if you force people to not buy U.S. assets, you'll have a weaker dollar and a lower trade deficit. But is that really what you want?
Hey, you mentioned politics a little earlier, at least from the Canadian perspective. Here in the United States, I'm wondering the sort of guardrails that you see on this president and his policies, because we're getting news now that Senator Ted Cruz, who's usually a staunch supporter of President Trump, sounded the alarm on the administration's move to ramp up tariffs, saying they pose, quote, enormous risks to the U.S. economy and make Republicans vulnerable to a, quote, bloodbath in next year's midterm elections. He said this stuff on his podcast, which was released today. This from our team at Bloomberg News. How do you see the guardrails around this president here?
So I think that's going to be what happens next. You're going to see more and more Republicans abandon Trump, and we're going to have real discord within the Republican Party. But unfortunately, the way the system works is that Trump does have a lot of discretion over tariffs. And unless his popularity plunges, and I would say like it's come down, but it hasn't plunged, he's not going to change direction. I mean, realistically, if you spent like a month talking about Liberation Day and then say, oh, wait a second, stocks have gone down, just kidding. He can't do that without looking really foolish. And so he's not going to do that unless there's a lot more pressure. We're just not there yet.
Hey, one thing I want to ask you. All right. So if we buy what you're saying about 44.50 by the end, and it looks, certainly possible considering what we're going through right now, where are you investing or suggesting investors suggest this money? You guys advise a ton of advisors, share your research. Where would you be putting money in this environment? Or is it too late to move anything around right now?
I think it still makes sense to have a defensive bias in one's portfolio. That means holding more cash than one otherwise would hold. It means holding more bonds, although there's, of course, risk around bonds given the large fiscal deficit and the whole Mar-a-Lago Accord discussion. But nevertheless, the Fed probably will be forced to cut rates quite aggressively, more than what the market is pricing in. So you want to have more fixed income, less equity. Within equities, you want to own more staples, healthcare, these defensive sectors. And you probably also want to own a bit of gold now. I think that's a true safe haven asset.
What would you say to folks out there who attempted to buy this dip?
Listen, I mean, if you're nimble, you can, of course, do it. But I wouldn't buy it with the expectation that stocks have bottomed. I think we could get a rally that lasts for a few days, perhaps even a few weeks. But ultimately, if we end up in a recession, and I think that's where we're heading, earnings estimates are going to come way down, and that will drag stocks down with them. So I think it's too early to move to an overweight stance on stocks.
Well, it's like we like to remind everybody, markets don't just go up. They don't go in one direction. They go up and they go down. Hey, Peter, thank you so much. Double duty. We know you spend some time with our TV colleagues as well. Glad you could also spend some time with us as well. As we said, this story by our Vildana Hyrick, it is one of the most read stories on the Bloomberg. Peter Berezin, he's Chief Global Investment Strategist at BCA Research, joining us from Montreal, Canada. Peter, thank you so much.
Hey, coming up next, we're counting down the TikTok to the TikTok, which just got extended. We're going to have the details in just a minute. First up, though, a check of the day's trade and top business stories as we're off the worst levels of the day. Hey, Charlie Pelley.
Hi, thank you very much indeed. As Peter Berezin was talking, he referenced 45.50 on the S&P 500 index, 44.50. Where we stand right now, 51.23. To put that call in perspective, we've got the Dow, the S&P, NASDAQ all declining. Tim mentioned we're off session lows, true, but still down 5.1% on the S&P. A drop there of 273 points, 51.22 where we stand now. The Dow is down 18.93. That is a drop of 4.6%, 1,890 on the Dow. The NASDAQ Composite Index is down 803, a drop there of 4.8%. 10-year at 3.99%, with the 2-year currently yielding 3.67%. Gold down 2.7%, 30.30 the ounce. And West Texas Intermediate crude has plunged 6.3%, 62.70 for a barrel of WTI. So again, the Dow, the S&P, NASDAQ, all declining. Tech stocks hard hit today. Case in point, Apple down another 6.2%, Nvidia down another 6.4%, and Tesla is slumping by 9.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thanks so much for that update, Charlie. Do appreciate it. Well, just before we came on air, we got the news that President Trump has said that he's decided to extend the deadline for Chinese firm ByteDance to divest TikTok's U.S. operations and give his administration more time to finalize a plan to keep the popular app running in the country. Trump said he will give Beijing's ByteDance an additional 75 days. Remember, it was April 5th was going to be the deadline, this deadline.
And
there've been others.
Let's not forget it. It stopped working for a while, right? It was shut down in the U.S. for just a beat. It's just
but
like
then we had to get it back.
You know, like Snoopy and Charlie Brown and Lucy. Was it Lucy that always like pulled the football out? That's what it feels like constantly. Sorry, TikTok football. All right, go on.
I think you're right. They were supposed to agree to this deal that would sell TikTok's U.S. operations to an American buyer and avoid a ban that was set to take effect as soon as this weekend. For more, we want to bring in Michael Shepard, Senior Editor for Technology and Strategic Industries at Bloomberg News. Also, Kurt Wagner joins us. He's Bloomberg News technology reporter. Kurt is also the author of Battle for the Bird, Jack Dorsey, Elon Musk, and the $44 billion fight for Twitter's soul. Michael, I want to start with you out in Washington, D.C. ByteDance, we got some comments from ByteDance. They've confirmed that the talks are ongoing as Trump announced this extension. What are the proposals right now that are being reviewed?
Well, the one that seems to be gaining the most favor and is viewed as the leading contender would actually not completely wipe out ByteDance as an owner in this new U.S. app that the plan would call for. Instead, what you would see is their holdings diluted to below 20%, and that would allow it to fit within the parameters of the law that Joe Biden signed last year, calling for Beijing-based ByteDance to divest to below a certain point and lower some of the national security risks associated with that. They would no longer have a controlling stake in it. Instead, you would see investors, including Oracle Corp, Blackstone, and perhaps Andreessen Horowitz also join in buying up, together with other investors, a 50% portion of this venture. And then ByteDance American investors would buy another 30%. And the idea would be that it would be an American operation, still with some nominal connection to ByteDance, but that in doing so and allowing this ByteDance ownership to remain, that would perhaps make it easier for the company to sign off on the deal and then also win the blessing of authorities in Beijing, which is no small matter.
All right, wait a minute. First of all, I don't even know who to ask. I want to ask both of you. Kurt, let me bring you in. Is there even a nominal connection to ByteDance? Is that even possible? If the concern is about any connection with China and potentially the Chinese government, is that even possible?
So the ownership breakdown that Mike described is possible under the law. I believe ByteDance could own, as long as it's less than 20% of this company, that would be allowed. But what would not be allowed, and where the sticking point is, in my opinion, is on the technology itself and control over the algorithm that people, that is used to show people posts in their feeds. So under some of the previously reported kind of discussions and plans that have been floated to Trump, ByteDance, even though they'd have under 20% ownership, would still control this algorithm. And according to the law, that is not allowed. And so ByteDance doesn't want to give up control of the algorithm. The law says they have to give up control of the algorithm. So to me, it's less about the ownership here that's the sticking point, and it's probably the technology and who gets to control it that's the sticking point.
Right, the holy grail that makes TikTok TikTok. Michael, come on back in here. Is that what's kind of making these negotiations tricky? I'm curious what you guys are hearing from the White House, because it is interesting that it's not like we've just said, that's it, TikTok's done. They keep expanding, the timeline here and extending it. So is that what's holding it up? Is what's up with the algorithm and who really controls it?
Carol, it's a good question. We don't have that much visibility into what is exactly happening behind closed doors in these talks, but the algorithm certainly is a sticking point. The law was very clear about whether ByteDance or any Chinese entity for that matter could remain in control of this really valuable technology that also allows potentially a window into American users and also a vehicle for perhaps disseminating propaganda in the U.S., which was another concern cited by U.S. policymakers when this was passed. So that is certainly one of the sticking points, but there are many others too, including ByteDance, for instance, just overall doesn't like the idea of this sale. They found it objectionable all the way back in 2020 when Trump first pushed the idea. Remember, he originally signed a ban, an executive order banning the app, and then set about trying to find a U.S. buyer. Of course, those efforts kind of just fell apart during the pandemic, among other things, and legal challenges too. But for ByteDance, this has from the start been a non-starter. The fact that they're confirming some discussions today is news, and it's really the first we've heard from them saying that they are in talks with the U.S. on this.
Hey, Kurt, who do you think in your reporting is the most serious contender to take over ByteDance's U.S. operations, TikTok's U.S. operations?
Well, I think there's a difference perhaps between who's the most serious and who's the most likely, because I think there are actually a lot of serious contenders, including, you know, Frank McCourt and Project Liberty. I mean, they're very serious about wanting to do this. But do I think they're maybe in the driver's seat? I would say probably not. I think Oracle, maybe to get to the real, you know, point of your question, like who is the most likely?
Yeah.
I think Oracle is probably the most likely to be involved here for a couple reasons. Number one, we know that they were part of the consortium of investors that was reviewed in the Oval Office on Wednesday by Trump and some of his aides. We also know that they have an existing relationship with TikTok. They already work with TikTok on cloud services, on data storage. And we also know that Oracle chairman Larry Ellison is a Trump supporter, a Trump donor. And because of those reasons, I think Oracle has sort of taken the lead in terms of who is almost guaranteed to be in a proposal from Trump. Now, again, as Mike pointed out, a lot of this depends on whether ByteDance and the Chinese government ultimately agree, which they may not. But the proposal that Trump puts forward, I think we all expect to have Oracle probably involved.
You know, Michael, one of the things I wanted to ask you is how much of these conversations are also related to the tariffs imposed on China. I'm just curious if it all kind of folds into one.
Well, you know, in the end, we joke here in Washington that it's all one story, and Trump has certainly tried to connect these two issues. The question is whether officials in Beijing share that view, that you can lump these things together. If you're Xi Jinping, for instance, do you think that there is such an easy trade-off between, you know, this company ByteDance that is considered a local star, and then the massive tariffs that Donald Trump has just imposed on so many exports from China into the U.S.? And, you know, is there really something else to be gained here for Xi Jinping by doing one thing or another in terms of this with Trump? Trump has reiterated his offer to China of perhaps lowering tariffs in exchange for getting some help and winning approval for a deal. Now, whether Xi Jinping is willing to do that, let's take a look and see.
Yeah, certainly. Kind of interesting to see what comes next. Hey, just real quickly, Kurt, Amazon, are they out? Are they even a contender too?
They are a contender. They did submit a bid. It's unclear exactly how serious it's being taken, but they did submit a bid this week, as we reported. If I could just make one final point on this about what's happening this weekend. Again, because this executive order was signed to extend this deadline, we presume that TikTok will continue to operate. But you may remember that last time around in January, when there was a ban, even though Trump said, hey, you guys have more time, the tech companies that support TikTok, that put TikTok in their app stores, or in Oracle's case that provide these cloud services, they were actually worried about following the law and didn't always take Trump's sort of executive order as being good enough for them to keep working with TikTok, right? So we have reached out to these companies. We're asking, hey, do you plan to continue to support TikTok technologically during this time? Because if you're Apple and you're sitting there going, hey, even though Trump says it's okay, a future president could come in and there are massive fines that they could face for breaking this law down the line if they choose to do so. So I think that's something we're going to be paying attention to, is even though Trump says it's fine, do their tech partners believe enough in his word to continue to support TikTok and keep it operational? And we'll only know that, you know, over the next 24, 48 hours if we see whether it goes offline or not.
All right, so 2 clocks ticking, 24, 48 hours. And then, of course, we've got 75 days because of the president's extension to figure out what's next for TikTok in America. Hey, guys, thank you so much. Have a great weekend. Mike Shepard, Senior Editor for Technology and Strategic Industries at Bloomberg News in D.C., and Kurt Wagner, Bloomberg News Technology Reporter. He's there in Denver. All right, folks, we've got a market coming off our lows of this session, still down 4.5% on the S&P 500, NASDAQ 100, down about 4.4%. This is Bloomberg.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. Steep losses for the U.S. equity market with the Dow, the S&P, NASDAQ all declining. Yes, off session lows, but still a drop of 4.7% on the S&P. Let's head right over to the first word breaking news desk for today's afternoon call. Lots going on. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks are plunging again today as China announced 34% tariffs on U.S. goods. The Dow is currently down 1,800 points. Like you said, S&Ps are down 4.7%, and the NASDAQ is off by 4.4%. The U.S. 10-year is sitting right at 4%. Gold and oil are sinking, and Bitcoin, that's higher by 2.5%. Among the main 11 S&P sectors, energy, financials, and materials are under pressure, and leaders to the upside in the Dow, Nike and Home Depot, while Boeing fell 8%. And led to the downside. Regarding the tariffs, Nike and Lululemon spiked intraday after Trump said he had a productive call with the General Secretary of Vietnam. And regarding IPOs, multiple IPOs have been postponed, including Klarna's. In other news, Trump says he will keep TikTok up and running for an additional 75 days. And wrapping things up, Powell says the Fed is well positioned to wait to consider adjustments. Live from the first breaking news desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill. Have a great weekend. And to hear live breaking news over your Bloomberg type squawk, SQUA on your Bloomberg terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the drive to the close.
Punk the music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody. TikTok, everyone. It's about 18 minutes to go until we wrap up the trading day and the trading week, and really a rough 2 days of trading. As you just heard from Bill Maloney and Charlie Pellet, we are looking at the major equity averages here in the United States bouncing off their lows of the session. We're still, though, down a lot by most measures. S&P 500 down 4.8%. That amounts to about 260 points to the downside. NASDAQ 100, that's where you find a lot of those large cap tech names, down 4.7%, a decline of 879 points. Dow Jones Industrial Average down 4.4%. It is down 1,793 points. And, I was kind of looking at the week overall here, and in terms of industry groups, and what we have seen in terms of drops, we have just seen incredible drops. Forgive me, I'm having like a hard time bringing up. Here we go. One day I'm just looking at kind of, it's just clicking. It's not happening.
It's kind of how I think everybody feels at the end of this week, Carol.
I was trying to get
What are you trying to do?
Oh, I knew what I was trying to do. I went in actually to the energy names. Here we go. Because 5 days, energy just getting smacked down this week. I was digging deeper and I got caught in it. Down about 13% this week overall. Even consumer staples, which is where you kind of go when the markets are rough, still down about 1.5% for the week overall. But let's see what Megan Horniman, who's been sitting by patiently as I get lost in my Bloomberg, Chief Investment Officer at Verdance Capital Advisors. I feel like, Megan, I've been at Bloomberg a long time. Tim's been here for a bunch of years. It's like you start digging down deeper and deeper, and it's very easy for us to get lost in the Bloomberg as we kind of dissect these markets. As you dissect these markets, the week, the past 2 days, what do you see?
I think this is kind of a resetting of expectations. That's what we're telling our clients. We're looking at not only expectations for growth now coming down, the likelihood of a recession rising. Inflation is really still an unknown. And then you have analysts trying to wrap their head around the earnings expectations. So we're getting this complete reset of valuations, reset of earnings estimates, reset of economic growth. And we've often seen that when you get these sharp resets, this can be painful. It can be difficult to watch. It can be, the markets can also swing much more, to the downside, even the upside. And we typically see this happen. And that's what we think is unfolding here over the past couple of days, is just trying to reset what we think these new tariffs mean.
I'm going to go with the opportunity in a day like today, in a week like this week, Megan. Is there an opportunity to be a buyer right now?
Yeah, absolutely. We've been waiting coming into this year to see some sort of a reset in valuations. Let's take the tariffs out of the equation completely. Coming into this year, growth was already slowing, and we knew that. Even analysts were expecting a slower economic picture for this year, but nobody had downgraded earnings estimates. And that was shocking to us. So we've expected to see some volatility, and we knew that there was this unknown with tariffs and the new administration in general. So we expected that volatility to pick up. We've been gradually piecing away as we've gotten some of these downturns. You know, we had a brief 10% correction in the S&P 500 earlier this year. We're now past that in correction territory and bear market in some indices. So we've been taking some of our cash that we came into this year and putting this to work. We've looked at the small and mid cap space because they're getting really beaten down by the fact that, again, they do carry debt and they're a higher risk sector, but they also tend to be a little bit more domestic. So can they be a little insulated from this? And also in the large cap space, while we aren't ready to jump into your Magnificent Seven or really the growth or tech, we are looking at some of the value areas.
Okay.
These areas have been beaten down too and offer opportunity.
What about geographically going outside of the US?
So we added to our developed international exposure at the end of last year, and we haven't added more to it. We're pretty comfortable where we are at this point. If there's investors that haven't, you're getting it cheaper today than you did even just 2 or 3 weeks ago. So it still is something we like for the long term. And just over a longer period of time, the developed international still are cheap compared to the US markets.
What would make you jump back into mega cap tech or just the large cap stocks in the S&P 500? What do you need to see?
I think you see some more downside. I don't think that it is reflecting at all. I mean, valuations are still priced at a premium to the historical average. The S&P 500 itself, when you look at just the PE, it has come down. So it is correcting, but it's not like it's overwhelmingly cheap. What we want to do is find when the market is pricing in all of the downside risks. And we think certain pockets of the US equity market are. We thought that, certain pockets of the developed markets have been pricing in the downside risk. But that tech and large cap growth, I just don't think is there quite yet. I'd want to see some more downside there.
I just want to ask you about, your thoughts on how you guys believe, or you believe that, I'm just looking at some of the notes that you shared with our team, that how the president and someone is, his administration are calling for this kind of whole reorder of global trade. This is a different beast. And I just wonder if we change the entire global trade landscape, is that a good or bad thing in your view?
Well, it depends on to what degree. So we talked about this on the podcast that I do here at our firm the other day. No longer are tariffs being used as a punishment for the fentanyl crisis or immigration. Now it's a tool to really reorder this entire global trade system. I think in the long run, this can have many benefits, but I don't also think that what we saw on Wednesday is what we're going to see for the long term. I still think you're going to see quite a bit of negotiations.
Wow.
And we've seen this from the Trump administration.
If that is indeed the case, we're getting such mixed messages then, right? We got the Vietnam news earlier. We saw a little bit of buying as a result of that. Maybe it means countries can come to the table. But the president also said in as much, I'm not backing down from this.
On the other side, he's also said he would make some adjustments. So we're getting that rhetoric from the White House that we're used to. It's kind of that back and forth. But let's just look at the picture.
We only have a minute left. I just want to jump in because if you're a CEO trying to run a company right now, how do you get used to that?
Right. It's difficult, but I still think you have to figure out where you can change some of your sources. How can you adjust things if you take those tariffs that were announced on Wednesday, and let's use that as the worst case scenario. So there's really only a way to go from there is up. So factor in some things from the worst case scenario, figure out supply chain, make sure that can't get disrupted. Think about your margins, think about, what you can adjust. But I don't necessarily think this is a bad thing for the long run. I still think companies will adjust. We've seen that with US companies, very resilient and find a way to adjust with all political environments.
Interesting. So,
by the way, I was wrong that we only had a minute left.
That's okay.
Megan.
That's
We're
okay.
keeping you. We're keeping you.
Because I could have went longer.
No. That's okay. That's okay. Well, continue then in terms of your thoughts on this.
Yeah, I think so. from what we got Wednesday, this is what we've told our clients, that's the worst case scenario. So this is what Trump has done. We're used to the rhetoric. He comes out strong. He comes out with, all swinging so that somewhere we can meet in the middle. I'm not saying that all these tariffs are going to be wiped away. I'm not saying that some of these won't stay. I think we should adjust to the fact that we are resetting the global trade relationship. I don't think that, globalization is completely gone. I just think this brings countries to the table to say, okay, what can we work with? And over the next couple months, I think you're going to see a lot of negotiations between the Trump administration and these countries. I think a country like China is probably going to play a lot more hardball, be a little bit more stubborn. But think about the countries like Vietnam, Japan, some of our biggest allies. They're going to be inclined to come to the table and figure out how we can work this through.
So would you tell people to buy the dip here? Buy this sell-off?
Start, yes. I think if you haven't started in the first 10% correction we got this year, start putting some of your cash to work. Yes. And we're long-term investors, and long-term investment cycles go through many different politicians. So it's 4 years in office. And if, going forward, you got to just think of, is this tariff impact that's today going to be the same tariff impact in the next 18 to 24 months?
But what,
I don't think so.
I think one thing that concerns investors is they hear comparisons to the Smoot-Hawley situation that was, exacerbated the Great Depression.
For those are on radio, I'm just going to say Megan kind of had a smirk there.
Who did? Who had a smirk?
Megan.
Oh, I didn't see.
Anyway,
Thank you for keeping me honest. Why are you smirking about that, though? I think there is some concern that something fundamentally is shifting here, that the world order that we grew up with, that we are so used to, that the way of doing business is fundamentally shifting.
I think that it is shifting, but I don't think that we have to go. We're not comparing this at any point right now to the Smoot-Hawley tariffs. I understand that the problem that investors are having as well is that's what they're seeing in the headlines. So like you mentioned when we started this, there's one side or the other to this tariff situation. There's nowhere in the middle. There's no economist or, we came in on Wednesday evening, everything I read was this is the absolute worst case scenario, so much worse than anybody anticipated. That's the first stab at this. We know that we have a negotiator here. So I think that we have to take a step back. Remember that he's campaigned on this. He was elected by the majority of the U.S. population or U.S. voters, that he would change this to make it more fair trade for the United States. We're not going to bring every manufacturing plant back here, but can we make this a little bit of a better playing field? That's what he's trying to accomplish, and that's what he got elected on.
No, forgive me. Let me just break in, because we did have the U.S. Labor Secretary, and I asked this of an earlier guest who just talked about this is not going to be the last positive jobs report under President Trump, that companies are now investing billions of dollars in the economy, the U.S. economy. So do you buy the idea that there is going to be a lot more investment in the United States, that we are going to build factories, we're going to make things, that's going to create jobs, that's going to be an economic boom? And is that what we really want to be, as a manufacturing economy? I have nothing wrong with manufacturers, but I'm just trying to understand, is this the kind of economy that really is the top economy in the world?
Well, there's the difference there is, do we want to be what we were 50 years ago? I don't think that's possible. But can we be something better than we are from a year ago? I think that is possible. And that's where I think there is going to be, we've already seen it, quite a bit of investment back here in the United States. And let's not forget, we're one of the biggest technology, just smartest people here that we have from a business perspective on the technology front. And, whether it's artificial intelligence, these are things that we can do quite a bit here in the United States. I don't think we'll ever be what we were before, but we can be better than what we've been.
We can do quite a bit, but we can't do a lot. We spoke earlier today with Rob Rich, CEO of the Optical Foundry. They're based in Minneapolis. They've got, Carol, 50 employees here in the U.S.
Yeah.
What they do is they sell eyeglasses to opticians in the U.S. and Canada and elsewhere. They source mostly from Japan, but also from China. They have some operations in Europe as well. I asked him, can he do this in the U.S.? He said there's no way he can do this in the U.S. He could buy the machines, but there isn't the talent here to do this. The same thing when it comes to apparel companies. We're not going to start making shoes here like they do in Vietnam. We just can't do that here in the United States.
Yeah, and you're exactly right. And he's right too. There are some things that we can't do here because of the labor force. There also is something that you've heard many of the politicians in the administration talk about, and that is retraining workers to different skills. And that's something that I think they'll see an effort to try and do that as well. But we're not going to be what we used to be. This trade, the trade and the tariffs and everything that's going on now from the trade perspective is to try and make it a little bit more fair to U.S. businesses, even to sell their products elsewhere. That's what the attempt here is to do. And if you think that the American businesses can adjust to this and can flourish under this over the longer term, then this is a good buying opportunity. I'm not saying we can build a plant in 2 years or a plant overnight. These are things that all have to be sorted out. But I do think in the longer run, are you worried that American businesses aren't going to be able to survive with what's going on? I'm not at all.
Hey, as we're talking, Megan, we're seeing the S&P 500 hit its worst level of the day, seeing some selling into the close. We're actually down 6% exactly on the S&P 500 right now. If we see selling in the next few minutes, what's the signal it sends to you?
We've seen this before with all the administrations. To go back to the Great Recession, this happened regularly as well. Nobody wants to go into the weekend. No one knows what's going to happen over the weekend. There have been other countries that have threatened retaliatory tariffs. We've really only seen it from China. Will we get some more information over the weekend? This is what we see. It's not surprising at all to me that on such a down day, going into a weekend with some selling into close.
Hey, really quickly, 30 seconds here, Megan. What's your expectations for Fed policy? Now, we did hear from Jay Powell earlier today in a speech. Do we need to see a rate cut or several rate cuts, or what are your expectations?
Right now, I still have the flexibility to be on hold in May and possibly even because it takes some time for all of this to filter into the economic data. But I do think it sets them up to be able to have that flexibility in the second half, which would also be a positive for markets. So would passing the Tax Cuts and Jobs Act.
All right, gonna leave it there. Hey, listen, so appreciate the time that we had with you. Have a good weekend. Megan Horniman, Chief Investment Officer at Verdance Capital Advisors, joining us from Maryland. Hey, folks, as Tim mentioned, we have taken another leg down here in the final few minutes of trading. So what does that mean? We've got an S&P that is down just shy of 6% as we speak. Dow Jones Industrial Average down more than 2,200 points, a decline of about 5.5%. The NASDAQ 100 also just under the 6% decline mark, down 1,100 points, 1,104 to be exact. And we're looking at all of the major industry groups in the S&P 500 down for the week overall. Some really deep losses, 14% lower on the energy market. Information technology down about 11%. Financials down about 10%. I'm looking at a lot of red on my screen.
Yeah, only seeing 14 stocks in the green in the entire S&P 500 right now.
I'm not hopeful for my gainers. We'll see. Hey, do not go anywhere. We're heading over to our TV colleagues, our simulcast, The Closing Bell. It starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through the global closing bell. A global simulcast starts right now. Scarlett Fu back from vacation. Carol Masser and Tim Stenovic still here in what's been a very relatively exhausting week for everyone involved as we welcome our audiences across our Bloomberg platforms, including our partnership with YouTube, with Stocks. Carol Masser now back at the lows of the day. The S&P down 6%.
Yeah, we were looking really closely to see whether or not we saw any kind of buying into the close here. But as you mentioned, Tim, Romaine, definitely taking another leg down. So we're looking at the worst week for stocks since March of 2020, back smack in the middle of COVID, in the beginning of COVID. And we've got the S&P losing something like $5.2 trillion worth of market value this week. So yeah, definitely one for a major, major risk off. Really coming off of course, President Trump's tariffs.
Look, not a good thing ever to talk about comparisons with the height of the sell-off during or ahead of the COVID pandemic, but we are seeing the worst day on the S&P 500 since March 16th of 2020, when that index dropped close to 12%. But we've given up our gains on the S&P 500 for going back almost a year. It's right now trading at a level that was last seen back in May of 2024.
Yeah, Yeah, let's not forget too, it's Friday and who knows what's going to happen over the weekend. People don't necessarily want to be long over the weekend because there could be a whole lot of pronouncements. There could be some deals announced and you don't want to be exposed to that. Having said all that, the rally in treasuries, the safe haven of choice, it's really lost a lot of steam here.
All right, we are getting the closing bells here in New York. I do want to point out too, equity option volume from both stocks and indices looks like it has actually hit a record high. It'll take a little bit while for us to get the final numbers on that. But remember, yesterday was the second most active day in the equity options market on record. And it looks like today has surpassed that to overtake a record that was set back a few years ago. The Dow Jones Industrial Average that you're looking at on your screen right now, closing out the day lower by 5.5%, a drop of 2,232 points, now settling at 38,313. The S&P 500 below 5,100, a drop of more than 300 points or 6%. You add that to the 5% from yesterday, and well, you can just do the easy math yourself. The NASDAQ composite down 1,000 points or about 6% as well. And the Russell 2000 down 83 points or 4.4%.
Yeah, let's not forget too, we saw credit fear gauges soaring. So a lot of nervousness in this market. We understand why. I look at the S&P 500, guys, almost every name is lower. 489 names losing ground, only 14 gainers. And again, S&P 500 ending the week down 9.1%, biggest decline since March of 2020.
And we should just point out the S&P, deeper into that correction territory. The NASDAQ 100, it is official. It is in a bear market, down more than 20% from its all-time high score.
So it should be no surprise then that when you look at the IMAB, it is a sea of red. Every single industry group in the S&P down at least 4.5%. If I were to look at it on a 24 group basis, there is one group that did buck the declines: consumer durables and apparel. And that's tied to Vietnam, of course, because if Vietnam actually drops the tariffs against the U.S. and Trump, of course, ameliorates the situation with Vietnam, that could be good news or less bad news for companies that rely on manufacturing in that country.
Well, that's a great setup for me because Lululemon is one of those names that could certainly benefit if we see a backing off of those tariffs against Vietnam. Lululemon, your second best name in the NASDAQ 100 today, guys, up about 3%. Earlier in the session, it was up more than 6%, but still a 3% gain after losing almost 10% in yesterday's trade. So as Scarlett mentioned, those names, those companies that have large manufacturing operations over in Vietnam, including Nike, including Lululemon, soaring after the president said that he had a really good call with that country's leaders. So that certainly stand out. And then I got to talk about the home builders because they also popped in today's trade. D.R. Horton among them, one of the top gainers in the S&P 500, finishing up with about a 4.5% gain here. And this is, of course, what's going on in the rates market, the U.S. rates markets, falling rates. Then you expect that to maybe make it cheaper for home buyers or folks who would like to be buying homes out there. So that was good for the home builders.
So many stocks in the red today. I just had to go with indexes. The KBW Bank Index follows banks, of course, down 6.6% today. In fact, banks had their biggest two-day drop going back to March of 2020. This after China escalated its trade war with the U.S. Capital One fell 8.2%, as did Bank of New York Mellon. JP Morgan Chase fell more than 8%. State Street down 8%. Goldman Sachs down 7.9%. Citigroup down 7.8%. Jason Goldberg over at Barclays reminded everyone that even though banks don't have direct exposure at the same level that other industries do to a global trade war, they have exposure to the industries that are affected by this. Of course, concerns about the economy, interest rate levels as well, also weighing on banks. Yeah.
Well, we should point out too, though, there is some direct exposure there when it comes to capital markets activity,
Yes.
Tim. You saw the IPOs that were put on pause today: Klarna, Mountain, Chime, StubHub, eToro, just to name a few. Not a single sale in the corporate debt markets today or yesterday. And then you top that off and you talk about just the general deal-making activity. There were several deals, several M&A deals that were also put on ice for right now.
Yeah, the tightening of
And those
financial
are fees
conditions
lost
that we've seen just in such a short period of time
Yeah.
has been pretty remarkable. Also, keep an eye on U.S. stocks or Chinese stocks that are traded here in the U.S. with the NASDAQ Golden Dragon Index down close to 9% today. This after Beijing retaliated against the tariffs with an extra 34% levy on all imports from the U.S. Shares of the Golden Dragon Index falling by close to 9% today. Still, analysts said that retaliation came sooner and stronger than expected, and it raises concerns about an escalating trade war, even at this point.
All right, let's go to the bond market, guys. Where do you go when you need safety? The bond market. But even the moves, I feel, were somewhat tame in relation to the massive sell-off that we saw within the stock market. So you got the 2-year down by about 3 basis points. You got the 10-year down by about the same. But on a weekly basis, you're just looking at 13 basis points lower for the 2-year and about 10 basis points lower for the 10-year. So it's still like a moderation of buying that we saw. Nonetheless, the 10-year around 4, dipping below 4% at one point, definitely significant. Can I honorable mention commodities for a sec? Because we had a huge sell-off in the commodity market, particularly when it comes to crude. I mean, down a whopping like 6% in a day. 5 days, oil in the U.S. is down a full 10 percentage points.
It's kind of interesting, too. I mean, I was keeping an eye on flows, and some of this, of course, only really goes through Thursday. But we talk about record inflows this week into gold ETFs. Significant inflows, at least on a relative basis, almost record level inflows into European ETFs relative to US ETFs here, and actually a lot of inflows into EM, and of course a lot of outflows in the US. And that great note out by Michael Hartnett this morning, in his words, actually telling people that maybe you short things right now as we enter a new secular bear market. Remember, in his view, it wasn't just about tariffs. It was also about the impact of Doge, and of course about the impact of DeepSeek back in January.
Yeah, to that point, just looking at flows, one-day flows, so this would be for yesterday, the Qs and Bill, which tracks short-term treasuries, saw the most inflows, but the volumes at which they saw inflows was minimal compared to about $4.5 billion coming out of SPY, which is the trader vehicle for the S&P 500.
You know, 2 things top of mind. We talked with our Gina Martin Adams. My concern is if the U.S., if this trade war stays around for a long time and it becomes a recession here in the United States, what happens in the U.S., it could ultimately, we're going to impact the whole world, right? If we see a global trade war, it's not going to be good for the global economy. It's something we talked about with Gina Martin Adams. The other thing is everybody says the caveat, what if President Trump changes his mind next week, in a month, or what have you? How long these tariffs last really determine what happens from here.
Well, walking it forward, though, too, have we seen capitulation, guys? When we talk about how many decliners are there versus advancing stocks within the S&P, and then that pickup in cross-asset volatility and the pickup in the VIX, are we finally clearing some positioning out, which would stabilize the equity market?
I don't know. I mean, we spoke to some folks earlier in the session today, early in our program, who said 4450 is what he expects on the S&P 500. So he sees further room to move lower.
All I can tell you is I'm ready for my pizza and wine, everybody. All right, that is a wrap. Have a good weekend. I don't know. Have you looked at your 401? I've looked at my 401k.
I will say, interesting day for Scarlett to come back from vacation.
All right, guys, have a good and safe weekend. Be sure to check out the surveillance special on Sunday. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place on Monday.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
It is a Bloomberg Business Week. Worth going over these numbers one more time, because I think it's fair to say the biggest sell-off going back to March of 2020 for the S&P 500, we can go ahead and call that a historic day. The S&P 500 falling 5.97% in a single day, the worst day in more than 5 years. The NASDAQ falling 5.8%. Officially, NASDAQ 100 now in a bear market.
Yeah, and I think what's interesting, we talked with Peter Berezin earlier of BCA Research, who's got a very negative forecast for the S&P by year end, 4450. And his point was what's different from that COVID sell-off is that it was followed by Fed rate cuts and a lot of stimulus. So a lot of money pumped into the economy. And that is why he is saying, the possibility of recession and why the outlook for stocks in the U.S. is not so great.
But and look what happened last time we had all that stimulus.
Well, right. We rallied off of it.
We did, but we got an inflationary environment for years to come.
Correct. But we definitely got a market bounce. Exactly. And we've been kind of working our way out of it. We've got a great voice that we want to get to. Liz McCormick is chief correspondent for Global Macro Markets, joining us from New Jersey. Liz, you've had so much reporting out there. I'm trying to figure out where we want to start, because what was interesting is I thought what Alex mentioned about what we saw in the bond market this week versus what we saw in the equity markets doesn't match up. Much more a negative tone in the equity trade. What is the Treasury trade telling you today after the week that was?
Yeah, and I was listening to you guys talk, and I heard Alex's points. I think in some ways, like if we look back, remember some days, intradays, it was like across the board. Each tenor and treasuries was down over 10 basis points. So
Mm-hmm.
we had some decent moves. We've kind of come back today. I'll talk a little bit about that later, but I think I was going to say bigger picture. If we step back, remember how far we've come. That the 2-year note yield is down almost a percentage point from the highs of earlier this year. 10-year note, it seemed like couldn't crack 4%, and it did. Now it's just trading quite, hovering near there. So I think the Treasury market has done it. I mean, if you look at the IN page for us, our indices, the U.S. Treasury index is up about, I think the last I looked as of yesterday, about 3% for the year. So it's kind of been doing its job. You have seen that flight to haven. It's just that superlatives, like you say, in these other markets, from stocks to what worries me, even though my main area is sovereign, what I really watch is credit risk, right? And like you mentioned, we have these CDS widening, junk bond spreads widening, all these other things, people pulling deals. That's where I worry that, like you're saying, it depends if President Trump really ends up negotiating, but certain things you can't put the genie back in the bottle, right? If credit risk keeps going, and then we get this hidden leverage, which is always like something that's lurking. If people start, losing on positions and leverage, things start cracking. You can't fix it that quick, right? So that's what I worry about. Yeah.
I am looking at the IN page. U.S. aggregate up 3.6%. Is that what you're talking about? Yeah. I mean,
yeah, exactly. Yeah.
Wait, say the page one more time for the Bloomberg subscribers.
Oh, I love that page. IN go, easy in, right? That's all our indices. And you can look at all the fixed income indices. And so that's at least good that, if you're in a portfolio, you're talking about your retirement, 60-40, at least the bond side has worked for you. So you have some gains where you're getting crushed in your stocks. But yeah, I think, today, let's talk a little bit, I mean, maybe you have a lot, but about Chairman Powell. Like, he was very calm, and I feel like led with inflation, right? Yes, the tariffs are bigger than we thought. Of course, he mentioned it would hurt growth, but he seemed very clear that they don't want inflation expectations, public inflation fears to kind of take off. So he was like very like, we have time to wait. So that's why I think
he seemed very calm. I mean, Jay Powell was a very measured, mild-mannered person. I don't know him personally, but it seems like.
Oh, come on. You can share. That dead concert you went to together.
I actually want to go for a bike ride with him, but that's neither here nor there. I think that would be a fun thing to do. But it does make me ask you, Liz, given his comments earlier today, did it seem to you that he was really calm about saying, hey, we've got time here?
Yeah, I want to say that I had a feeling, and people I think thought I was crazy, that like, even though the market, let's say the swaps market pricing and Fed cuts was really kind of getting over its skis, pricing in almost 5 cuts this year. I said, let's be wary that Chairman Powell, because that's his job. He has a dual mandate, right? And like you're talking about, everyone's cutting their their growth forecast. Simultaneously, they're lifting their PCE forecast, right? So this is, I hate to use that word, this is a stagflationary thing. So, and the Fed kind of never got, I don't want to fault them, but inflation hasn't like sustainably got to their 2% target after the pandemic. They did a lot of great stuff, and it's down. So I think he's very weary, because he knows if you let that inflation genie out of the bottle, that's the worst problem for them. So I think that's why he was very measured and calm. And we will see. Like we had yesterday, we had some economists saying no cuts, some saying 5 cuts. It's like all over the place. So I think they're waiting to see. But Powell was very calm.
Well, one thing I want to ask you too is you always check in with all the trading desks, the global, fixed income bond trading desks around the world. Were people kind of freaking out? Were people saying, yeah, we've got a global recession coming? I mean, it's all interconnected, right? It's not just, even if we are pulling back on global trade, I mean, what happens here is going to matter what happens in other countries. I mean, it's important. So I'm just curious, what was the tone, Liz, that you were hearing?
Yeah, I would say like overall for investors, I mean, again, it's a bunch of superlatives, but this, even though we had the stories about Mar-a-Lago and we thought, think Trump will go out of the box, I do think, Carol, many investors feel like this on trade is a seismic change, right? He's trying to reorder everything, right? And he said, Trump has said he's willing to take some pain, but they didn't realize, I think everyone keeps saying to me, Liz, we knew there would be quote unquote reciprocal but not by this math that they pulled off, right? That was much higher than they thought. So I think that's what everyone said. It's worse than I thought. I will say Dan Iverson of PIMCO was kind enough to talk to me today. And he's, they've been warning for a while that, hey, this tariff is a risk and just to be cautious. And, but he said that what President Trump rolled out was a little more hawkish than they even expected. So I think everyone was taken by surprise at how kind of stringent the tariffs were.
All right. So there is that. Is there also an expectation, Liz? I mean, this is a lot of, this came up in a lot of our conversations today, is that the expectation is just like we're seeing with Vietnam already, right? Lululemon rallied, Nike rallied. There were names that rallied because there is that expectation that these countries are going to come back and negotiate. Is there in the investment community the same feeling?
Yeah, I mean, I had a few say to me, like hope is not a plan. Even though they hope to see this, and like you said, there was the positive signs on Vietnam, although China kind of came in hard. The EU has said, and we have stories on that they're hoping to negotiate. So I think there is some hope that this doesn't turn out to be as bad as it seems at the moment. But then we have President Trump coming out on social media kind of saying, hey, my policies are stuck. So I think people are very kind of on Tinder hooks. They're not sure.
But let's play that out for us, Liz, a little bit, because I think that is sort of the optimistic view here, that this could be an opening salvo. And we could see a situation like we got a little preview of with the Vietnam news earlier today, where we did see stocks bounce a little bit off of their lows as a result of that post from the president, who said, the country is, wants to take their tariffs away. If that is indeed the case, it still sets up for quite a bit of uncertainty. And we know that what executives don't like is uncertainty. They want to be able to plan where their next plant is going to go. They want to be able to plan who they're going to hire for the next year. And if these things can get implemented and then pulled on such short notice, I think that could create a challenge for these companies.
Yeah, I 100% agree that, even if there's some negotiation, I don't think also, Tim, that anyone thinks that there'll be a wholesale reversal. President Trump wants a more tariff-heavy policy, right? So even if the worst of this is dialed back, it's still very different. But I think you're right. Many companies are saying, how can I put out a big investment? I don't want to sell new debt now. I'm not going to add to my hiring, all these things, because like we always say, but it's true. Uncertainty is the worst thing. And when I was trying to do the coverage right after, and we were figuring out what's going on when President Trump gave his speech on Wednesday, the quick thing from a lot of people, even after we got the full chart, is we thought we were going to get full certainty and now we don't, you know what I mean? And I think like even on the negotiation, people don't know. And I want to bring in like, I don't, maybe you've been talking about this all day too, so sorry if so, but like, let's think about, there's the tariffs and then there's the wealth effect. Like, Carol, you were joking about your retirement.
No joke.
I told Carol, I wasn't joking. I told Carol, maybe this is a night when she goes and orders the pizza, not to get toppings.
Exactly. I mean, it's real. You start to say, well, or somebody was going to switch jobs, maybe not, at the margin. I mean, maybe this is like soft data, so to speak, but your retirement account is real. And even non-retirement, I've got young 20-some kids looking at their portfolios. So I think everyone, it feels a little less rich. And that does factor into whether you're going to buy that new thing. So again, even if slowly some of this gets negotiated down, those factors, I don't think the stock market will be jumping. We're not buying all the dips now, right? So I think it's a little bit of a longer process. So and again, I hope we don't get things that break, leverage comes out, the basis trade blows up, all those things that, once that gets going, it creates some more kind of systemic issues.
Well, that's what I think about. What's most vulnerable right now, Liz, in this environment? Because I do think about, right, that the idea of like stopping something versus starting it up. Stopping it can be easier than getting it going again. I think about the economy and what could be some of the lasting impacts of this tariff policy, especially as you say, this is something President Trump has been behind for a long, long time. And it doesn't feel like he's going to roll back so easily. Even if he pulls back a little bit, it's still going to be there. And I do wonder about the longer term impact on the US economy here.
Yeah, and I think these hidden things are that remember we all lived through 2019. We haven't had a repo issue like seismic now, but leverage. There's things, when people start losing money and you get margin calls on different things, then you start selling things that you can, and that stuff you don't. It's like you don't see coming all the time, right?
Mhm.
And that creates issues. And then, like you said, even like liquidity in markets, when that starts to break down,
Mhm.
and that's what the Fed is concerned about, market structure. But overall, remember we were like, oh, before all this, maybe we're going to get through this with this like rare thing of no recession. Fed tightened all this way, and now they dialed back and no recession. Now let's say the worst of the Trump tariffs aren't laid out, but like you both said, that still structurally there's tariffs. Who is it? JP Morgan saying if this continues, we get a 60% odds of recession. It just seems like the recession case, even if it's not this cataclysmic near depression, people are sometimes saying globally now, that slowdown we thought we'd avoid, that economics recession we may have it, right? So that's
exactly.
enough to kind of keep the edge off stocks and other things.
We've
right?
already seen sentiment, consumer sentiment pulling back. We've seen business spending pulling back. So yeah, just watching all of these indicators. Liz, this was such a great deep dive. Thank you. So appreciate it. Have a great weekend. Liz McCormick, she's chief correspondent for global macro markets. Highly recommend you check out all of her work on the Bloomberg terminal and at Bloomberg.com.
It may be Friday afternoon, Carol, but we are getting some big news right now. Two redheads crossing the Bloomberg terminal just in the last couple of minutes. One has to do with the VIX index closing at its highest level, going all the way back to April of 2020. The other one, which is causing shares of companies that make these drugs in the after hours to move lower, is that the Trump administration has dropped Biden's Medicare obesity drug coverage proposal, looking at shares of Eli Lilly dropping 2.9% post-market, ADRs of Novo Nordisk falling 3.3% in the after hours.
Yep. So it continues. And just want to remind everybody, we talked about the VIX a little bit earlier on. Another gauge that we follow, certainly a sign of fear in the markets, hitting 45.31 at the close. It was up as much. Yeah. It pretty much finished at its highs of the day. So a very key level going above 40. And so that was pretty significant, as we mentioned. So VIX closing at its highest level since April of 2020. We keep going back to 2020.
Yeah. Well, our next guest argues that in any normal day, such as today, our day would have been dominated by Friday's U.S. employment report. But today, it's barely an afterthought. Indeed, that turned out to be the case. We've got with us Bloomberg News macro strategist Cameron Kreis, who joins us from Connecticut. Cameron, I know you've been busy today. We appreciate you taking the time. The title, you have many posts just today, but the one that really caught my eye is "Questions Abound as the Whiff of Crisis Gets Stronger." What is the crisis that is starting to emerge right now?
Well, you alluded to it in terms of the price action. There are just, however you sort of look at it, days like this, and yesterday, you typically only see during periods of extreme financial stress, periods like COVID, periods like the GFC. And there are a number of metrics that you can look at that sort of only tick the box when you are in periods of acute financial or economic stress.
Let's talk about some of those metrics real quick. Let's talk about some of those metrics real quick, because as you
you just alluded to the VIX. You can look at the change in credit spreads. The level of credit spreads is still reasonably healthy, but the rate of change is obviously you've seen a very, very abrupt widening that you don't normally get in sort of just organic market conditions. You only get that sort of big rise in junk bond spreads or investment grade spreads when there's stress out there. If you look at the sort of a trailing ratio of the size of up days in the S&P versus the size of down days in the S&P, obviously we've had a couple of big down days over the last couple of days, but over, say, the last 2 months, the magnitude of your average down day has been very, very much larger than the magnitude of your average up day. And that spread is the sort of thing that we've only seen in the past sort of quarter century, during COVID, during the GFC and during the Eurozone sovereign crisis. So, I like to say that you can tell a lot about the market by the company that it keeps. And when you see this sort of price action through a number of different vectors that only really kind of crops up during these prior periods of acute crisis or acute stress, that kind of tells you that we're not going to go back to slow and steady anytime soon.
Yeah. And, I'm just going to go through some of the superlatives again. We were doing it with our TV colleagues. S&P 500 ending the week down 9.1%, biggest decline since March of 2020. NASDAQ 100 entering a bear market after falling 21% from its record. S&P 500 plunging 6%. In the worst route since March of 2020. So we're talking about today's trade. And then you have the VIX, as we mentioned, highest level since April of 2020. And then the Bloomberg Commodity Spot Index capping 6.8% in a 2-day drop. Having said that, we had a conversation, I think it was yesterday, Cameron, where people were saying, yeah, but it feels kind of orderly. Yesterday, we actually had some names, a decent amount in the S&P 500 that actually were up on the day. What is it going to take for full market capitulation? What says to you, is it what we hear from the White House ultimately that will determine full market capitulation, at least on the equity side of things, or just overall?
Well, I think we saw a whiff of it today. As you alluded to, I think there were 95 names in the S&P that were up yesterday. Today, there were only 14. Mm-hmm. So clearly yesterday, people were trying to do some sort of rotation trade to sort of hide out in defensive names. Whereas today there was a lot more just blanket selling. That having been said, as you alluded to a few minutes ago, this Vietnam stuff did engender a bit of a rally in some of the apparel and footwear companies. So I suppose you could argue that same process was in train a little bit today. But, when you only have 14 names out of 506 or however many there are, that's pretty indiscriminate selling. So, combined with some of these other metrics, I think maybe you can say we're starting to see a few babies getting chucked out with the bathwater.
Can I just throw in there small caps, peak to trough? Peak was back in late November. I think off like 25%, just slammed.
Small caps have, they've been, am I allowed to say the redheaded stepchild of the equity market? Is that,
you just did.
I allowed to say that?
It's out there.
That used to be a phrase you could use. They've been sort of the poor cousin of the S&P and the NASDAQ for some time now. And, I think they're also, it's reasonable to say that they're probably more exposed to the pure domestic economy in the sense of what this tariff stuff does, as you alluded to, it increases uncertainty. When people are uncertain, they pull back on purchases, they pull back on investment. And it also represents, at its very basic level, a tax hike, right? It's a consumption tax. And the U.S. economy is nearly 70% consumption. And if you're going to apply this sort of from above, this very substantial tax on consumption, kind of by definition, you're reducing the purchasing power of the public. Public's going to buy less, they're going to spend less, the economy is going to grow less. And small caps being particularly attuned to the fortunes of the domestic economy, not maybe having the shall we say, the tax flexibility that some of the larger cap companies have in terms of offshoring revenues to maximize tax efficiency.
Right.
Yeah, they are a sort of a leverage play on the downside of the economy, and that's kind of what we're seeing play out.
Well, Cameron, given that we're seeing tariffs at a scale that we haven't seen in close to 100 years at this point, so for all of us,
I think it's probably fair to say that nobody alive has seen this.
Exactly.
Before.
I was just going to say, we've never seen this in our lives before. End with a prediction for us about how this ends. Does the president keep the tariffs as they are? Does he decrease them? Does the U.S. economy adjust? Like, what do you think happens here?
I would say that I and virtually everybody else out there expect some modification. I mean, it's sort of the style of the president to go in hard and then negotiate concessions and then relax some but not all of the initial tariff announcement. We've seen that already play out vis-a-vis Canada and Mexico already this year. So I think everyone expects some sort of pullback in terms of the if you will, the global effective tariff rate. Now, will that apply to China? Not necessarily, because I think there is maybe more of a geopolitical orientation in terms of the tariffs with China. That having been said, as you've said, all of this still creates a lot of uncertainty, right?
Yeah.
So I think next week people are expecting that there's going to be some sort of pullback in the overall level of tariffs. The 10% blanket tariff that goes into effect on April 5th, I think people have pretty much accepted that.
Right.
So between April 5th and April 9th is really the key date. So April 5th obviously is tomorrow, so no one's going to be trading tomorrow, thankfully. So between Monday and next Wednesday is really going to be an extraordinarily tense and volatile period. There's going to be at some point an attempt to rally the market, either on a rumor or an expectation, or indeed a headline that something has been modified in a more friendly fashion. That having been said, in the longer run, a 10% tariff is still a shock, right? Anything on top of that is still a shock,
and it has an impact.
It's gonna have an impact. So I think it is going to be quite deleterious to U.S. And global growth. I think it's going to be quite deleterious to U.S. earnings, U.S. margins. The same elsewhere. So my expectation is that there's probably a bit more downside ultimately for U.S. and global equities. It's in a sense, the era of globalization was also an era of financialization, and U.S. equities were the disproportionate winner of globalization.
And I got to say, I want to leave it on that note because it's something we talked about too with our Gina Martin Adams, the idea that what happens in the United States, I mean, we're not just talking about maybe a U.S. recession, but we're talking about a global recession. And so everybody, feels the pain, and there's really no place to hide for the most part in terms of the investment environment. Hey, Cameron, thank you so much. Look forward to your reporting next week. Cameron Kreiz, who's Bloomberg News macro strategist, joining us from Connecticut.
He mentioned uncertainty. It's something we're going to be talking about in just a couple of minutes. In the meantime, though, let's get on over to Charlie Pellet with an update on how the market's closed and still news happening in the after hours.
Indeed,
hey, Charlie.
yes, our coverage continues. Bloomberg will keep you posted on any market developments. Do want to begin, though, with a couple of other red headlines crossing right now on the Bloomberg Professional Service. The U.S. Supreme Court is letting President Trump halt teacher grants cited as DEI. The Trump administration also is not moving forward with a highly anticipated decision on whether costly obesity drugs would be covered by Medicare. That in its annual regulatory update today. We are seeing shares of both Novo Nordisk and Eli Lilly tumbling right now. We've got Lilly down by about 0.8% in the after-hours session. Also moving lower, shares of Novo Nordisk, they are down after hours as well. Market coverage, S&P 500 plunging 6% today, and the worst rout since March of 2020. The Bloomberg Commodity Spot Index capped a 6.8% two-day drop. The VIX closing at its highest level since April of 2020. Bottom line here, steep losses for U.S. equities. S&P at the lowest in 11 months, slashing $5.4 trillion in market value in just 2 sessions. S&P down 322, down 6%. The Dow today down 5.5%. NASDAQ down 5.8%. The 10-year 3.99%, with a 2-year 3.64%. Spot gold down $78, down 2.5%. West Texas Intermediate crude down 6.4%, down at 62.54 a barrel. So what is happening with markets? Megan Horniman is Chief Investment Officer at Verdance Capital Advisors, and she was a guest right here on Bloomberg Business Week Daily.
I think this is kind of a resetting of expectations. That's what we're telling our clients. We're looking at not only expectations for growth now coming down, the likelihood of a recession rising. Inflation is really still an unknown. And then you have analysts trying to wrap their head around the earnings expectations. So we're getting this complete reset of valuations, reset of earnings estimates, reset of economic growth.
Megan Horniman of Verdance Capital Advisors, interviewed moments ago right here on Bloomberg Business Week Daily. Bottom line here, stocks lower across the board. S&P today down by 6%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, Tim Stanovic live here in our Bloomberg Interactive Broker Studio on Bloomberg Business Week Daily. Do want to mention a headline, a lot actually coming here late on this Friday afternoon. The U.S. Supreme Court cleared the Education Department to withhold money for teacher training projects in 8 states, intervening for the first time to bolster President Trump's campaign to wipe out federal spending programs he opposes. 5 of the court's conservative-leaning justices to halt a trial court order that had temporarily required the Education Department to keep covering incurred expenses in the 8 suing states. The Democratic-led states went to court after the department canceled 104 of 109 grants under 2 training programs because of concerns about diversity, equity, inclusion. Should point out, Chief Justice John Roberts and the court's 3 liberal members indicated that they would have denied the government's request. So again, some late news here on this Friday. There's a lot of it.
Speaking of a lot of news, I do want to remind everybody that there is Sunday coverage, a special edition of Bloomberg Surveillance, 5 to 7 p.m. in the on Sunday, covering everything you need to know going into Monday's trade. Do check that out on Bloomberg TV. Well, one of the things that Carol and I heard repeatedly over the last few weeks, as our guest counted down to April 2nd, was that there'd finally be some certainty. We know what the president was thinking when it came to tariffs. In other words, executives would know what was coming so they could plan their capex, shore up supply chains, hiring, get on with selling things or providing services. Well, we got our answer on Wednesday, and as Bloomberg News senior economic writer Sean Donnan notes for Bloomberg's Weekend Edition in an essay, the uncertainty is not going to end. Tariffs, he writes, are just the latest symptom, but the causes are deeper and go well beyond Trump. We've got with us Catherine Bell, Bloomberg News Weekend Edition editor. She joins us here in the Bloomberg Interactive Brokers studio. We're going to touch on Sean's story in just a second, Catherine. But before we get there, I just want to get inside your head a little bit as the editor of the new Weekend Edition to hear from you about how you go into a weekend such as this, planning what the writers are going to write after a week that we saw.
Right. So the thing about the weekend is that we have been working on the stories in many cases for a long time when we get to the weekend.
Right.
And so it is a little harrowing, honestly, when so many things change at once in a week. But really, what we think part of the point of the weekend for our readers and really for ourselves as well is that you may not have a lot more time on the weekend that you do during the week, but you have more intellectual space when the Zoom meetings and the market slow down and the markets close to really step back and think about what's happening in a more expansive way and try to understand why, and to think both back into history to kind of understand the context of what's happening, and also to think ahead about what may happen next, and to try to just take that pause to understand things a little more deeply. So in our essays and in dispatches we get from our reporters around the world, we're really trying to see what's changing in a more thematic way. So we're really happy when the pieces we've been working on for quite a while often just feel right at the moment when they come through. And also we do sometimes do a lot of shifting things around at the last minute.
That's so true. I have to feel, I can't tell you how many times like there's things that either I hold to the weekend or I look for the weekend where I can settle down and kind of get, as you say, the history or kind of more meat behind a certain situation. Having said that, you talk about uncertainty, and Sean Donnan does have a story that is part of Weekend Edition. So tell us a little bit about how he was thinking about it, especially when it is a word that comes up almost in every conversation we have, and often multiple times.
Right. So he calls the global economy right now a perpetual uncertainty machine. And he,
ouch,
I know. And he basically says, if you're feeling uncertain, get used to it, because this has been brewing for a long time before Trump, and it's going to keep going. So obviously, Trump is drastically increasing the uncertainty with all of the moves that he's making, and the rest of the world is feeling that. But there are forces that have been percolating for a long time in the way that the economic order has been shifting, and also in technology with AI. And, we really don't know how that's going to play out, no matter how much we try to predict it.
It's an interesting perspective, right? Because we are using it so much, but you're right. We've been talking about populism, right? The rise of populism over the last couple of years is not just something that happened overnight.
Yes, exactly. John Authors wrote a piece for us a couple of months ago, actually right after the election. And one of the things he said is, when you feel these huge economic shifts in the global order, usually they're kind of ratifying something that's been taking shape for years. And in that piece, he argued that what's happening now has been a shift that started with the financial crisis.
It's pretty remarkable, because if we think about it just from the perspective of onshoring or nearshoring, and I think what the president would want to see is a return of manufacturing to the United States. We haven't found one person who says that we can actually bring manufacturing back to the US. What they do say is, if we do see investment by US firms that traditionally have built or have manufactured in what we would refer to as developing countries, that what you would see here is automation. And you'd see that those jobs that exist outside of the US wouldn't exist here, because we don't have the workforce, and we wouldn't pay the wages that for the products that would be required to actually support workers here in the US. It's all about automation.
Right.
Like a fundamental shift in the way that companies do business.
I mean, you can't separate all these strands out, right? There's all of the political shifts, the economic shifts, along with technology. And what they're trying to do right now is undo many decades of very complex changes in the global economy. And that can't just, this is a very blunt instrument, but it can't just happen overnight like that. It just doesn't work that way.
I wish we had a couple glasses of wine, because this is like one of those deep things. But I do think about the global pandemic. We were like,
I can get you some wine.
Yeah,
it's Friday afternoon at 4:40.
I may hold you to that. But I do think about, this, Catherine, that the global pandemic seemed to come out of nowhere. And there we were, and shut down truly the global economy. Like, who'd have thought that could have happened a little bit more than 2 years ago? All of a sudden, artificial intelligence was something we couldn't stop talking about. And we were still we're on just the cusp. We had a Bloomberg Intelligence event this week that we participated in. And it was like, wait a minute, they're pretty upbeat. The spend is still happening, and maybe there's some changes and stuff, but everybody's moving forward on it. So amid all this uncertainty, there's a lot of uncertainty going on about how our world will be in 6 months, 12 months, 5 years.
Right. Sean talks about an uncertainty index, where these three economists looked back to 1900, and they tried to quantify uncertainty. And of course, in the financial definition of uncertainty, the whole point is that you can't quantify it. You can't put a price on it like you can risk. But they do try to go back and measure uncertainty going back, well before the Great Depression. And what they find is that what's happening now is off the charts. And I think it is these kind of exponential shifts in technology, along with, generational changes in how the economy works.
So what are the ramifications here? If a CEO doesn't understand what's coming, if an investor doesn't understand what's coming, if somebody can't plan for the future because there is so much uncertainty?
Right. Well, CEOs hate uncertainty. And I think, you get more conservative decisions, you get more short-term decisions, you get worse decisions, I think, some of the time.
Such a timely article. And like you said, it's something you can kind of just have a second cup of coffee or a glass of wine if it's dinner. But I really love this, because I really do think we have to kind of sometimes step back and think about more broadly what's going on. Catherine, thank you so much. Weekend Edition hits when?
It's already out. It's It's
Not
there.
fair. It's
Yep.
not our weekend.
We're almost there. It's on the Bloomberg and it's at Bloomberg.com.
It is, yes.
So check it out, everybody. Catherine Bell, Weekend Edition editor, joining us here in studio.
All right, well, let's take a look at the markets to remind everybody about the carnage that we saw today. Is that fair to say, Carol?
I mean,
I don't want to.
Markets go up, markets go down, and we
Well,
know
on a day
big
like today, they
reason
went down
why.
the most since 2020.
I know.
Okay, just
We're still up though, right? If we look at the last,
yeah. If you zoom out 100 years, Carol,
no,
the
if you
chart
go-
is up. No, I'm just kidding.
What is it that we heard? Who said that to us, right? That
If you go back to the Great Depression, I'm just kidding. I'm just kidding. We have to have a little bit of a sense of humor.
Wise.
Look, you type in GP on the Bloomberg terminal. It
Yeah.
takes you to the chart.
Yep.
You go back to a 1-year chart, and yeah, we're at levels last seen in May. Is that
right.
what you're trying to say?
Yeah. Okay. Yeah.
Okay.
Okay. We'll
No
see what
toppings on
happens.
that pizza tonight.
No, there will be tons of toppings. Hey, what we wanted to get into, I mean, we've talked with Amanda Mull before about kind of the Buy American movement that's been out there, has been periodically invoked since the Boston Tea Party with the goal of promoting economic nationalism and strengthening the U.S. economy. We're hearing it. We're hearing from Canadians, buy Canadian goods. We're hearing it from America, buy American.
Well, President Trump wants companies to move their production to the U.S. He wants your shoes, your shirts, your cars, your iPhones to be made in the U.S. He wants you to buy American.
Where are Jimmy Choo's built?
Did I say? I said shoes, not Jimmy Choo. I don't know where Jimmy Choo
Is there any difference, Jimmy Choo's?
I am out of my element.
Let's see what Amanda Mull has to say about
this.
that.
She's senior reporter at Bloomberg Business Week.
Did
Amanda,
you remember Sarah Jessica Parker in I can't even think of it. What is
Sex
it
and the
called?
City?
Sex and the City. And
I've
she's like,
never even seen an
she
episode of that, and I knew what it was.
She lost her shoe, and she's like, she didn't say, I lost my shoes.
shoes.
My shoes.
Yes.
Amanda Mull, joining us from Brooklyn. Good to have you here. How are you?
Thanks for having me. I'm doing pretty well, all told.
Yeah, it's a little rough.
A lot going on.
There is, I wanted to get you back on our program to talk again about this Buy American movement and the history of it.
Mhm.
We got to speak to you a few weeks ago about this, but that was before we heard about exactly what the tariffs would look like. You looked at a history of these Buy American movements. What did you find?
Well, Buy American is, I think, probably best understood as the sort of like marketing campaign, the public messaging campaign that goes along with protectionism in the United States. So you see it pop up here and there over the course of history. The first, what could be realistically called the Buy American movement, was before the American Revolution. It included the Boston Tea Party. It was resistance against economic domination from England. And then over the course of history, there's always sort of like an idea of Buy American out there, but you really see the campaigns kick into high gear and get a lot of sort of highly placed business support during times of major recessions, and especially during times where economic leaders, political leaders want to put tariffs in place and put really, really broad tariffs in place. So it I think is not much of a surprise that it's back again.
Did it work? Has it ever worked?
Well, it depends on what you mean by work.
Well, how do you see? I guess how do you interpret the way that President Trump wants it to work?
I think the Trump administration wants manufacturing to move back to the U.S. I don't think the Trump administration has a trade policy that would cause that in any large capacity. I don't think Buy American would work right now. But I think that the idea right now is to sort of whip support for the idea that the U.S. can reindustrialize, to whip support for the idea that this is ultimately something that will make America's economic position stronger, more stable, that will make America great again, honestly. And I think that it is really unlikely it would work in that scenario. There's some ways that I think they're looking at this that it probably will work. And one of those is that historically, the biggest support for Buy American movements comes from the leaders of really, really large American business empires. William Randolph Hearst in the 1930s was sort of like single-handedly astroturfed the idea of Buy American into the public consciousness. That was, of course, an era of really high, really broad tariffs. And he, owned more than a dozen newspapers. He He had great control of mass media in the US. And he basically said, said to his employees, we are putting this in front of people until they believe it. And, you see that echo over and over again in history.
And the thing is, I love how you say, buying American or buying, is not straightforward. Delta's a US airline that flies hundreds of planes made by Airbus, which is headquartered, we know, near Toulouse, France, and builds its aircraft at factories in Europe and North America. So does flying Delta constitute buying America? I mean, this is what we have been moving towards. Consultants said, do it. Globalization, right? Everybody's going to benefit. It helps developed nations develop, right? And so, and enter the global economy and become consumers and advanced consumers, where then maybe more and more people benefit. So you just do wonder whether or not this idea of globalization, can you really roll it back? It feels like it's a mega pushback right now, but I don't know.
I think something that keeps coming to mind for me is that, like, in the history of industrial society, we have never seen a country reindustrialize.
Yeah.
Like how that happens is just like not clear. If it can work is just not clear. So you have this situation where America is a consumer society. That is what our economy is based on. U.S. household consumer spending makes up nearly 70% of GDP. We have structured our economy and our society and our political landscape around being a country that consumes more than it produces. Consumes, I think, more than it feasibly could produce.
Yeah.
Because America consumes so much that we need essentially the productive power of the global population to fuel that. So you're looking at potentially a big decline in the ability to consume in the US, which is not good for the economy.
Yeah, it's kind of fascinating. It's also that one of the things that came up during the week is just like, where do you get the folks to make all the manufacturing? And then you've got to make sure that it's all automated and make sure that we can do it that way. Because China is even telling its kids to study manufacturing to fill the factory jobs. And same problem is here. Amanda, great stuff. So appreciate it. Amanda Mull, senior reporter at Bloomberg Business Week, joining us from Brooklyn. Check out her story on the Bloomberg.
Hey, speaking of reindustrialization, I do want to go to China because I've been eager to chat with Ben Harburg. He's not in China right now, but he spends a lot of time there. He's the founder and portfolio manager of Core Values Alpha, where he manages the CVA Great China Growth ETF. The ticker is CGRO. For the year, it's up about 5%, yet down close to 16% from its highs just about 2 weeks ago in the middle of March. The top holdings include Xiaomi, Alibaba, BYD, Tencent, and more. He joins us from Abu Dhabi, where it's close to 1 a.m. Ben, we do appreciate you staying up late for us. When we spoke to you a few months ago, you were in the U.S. You were here for the inauguration festivities around the inauguration of President Trump. You were optimistic. You were bullish. I wanted to check in with you again now that these tariffs have been announced and get your view on how you think the first couple of months have been.
Well, I don't think anything that's happened is unexpected. He talked about tariffs nonstop on the campaign trail. He promised tariffs. He threatened even higher tariffs than have been imposed. For instance, on China, he threatened 60% tariffs. And so it would be disingenuous to say that, this is hugely unexpected and a complete shock for anyone that's been following the situation closely. We expected there to be turbulence out the gate. They warned that there would be pain associated with the tariff regime. There would be pain in the public markets. There would be even pain in people's pocketbooks, but towards the greater good. So I think it's too early to judge.
You say that nothing has happened that caught you off guard, but it caught a lot of people in the markets off guard, given the decline that we've seen just in the last 2 days. The market wasn't prepared for this.
That's right. But again, I think there's just historically been this kind of hesitation to take Trump at his word, and kind of just an assumption that it will be a kind of a veiled threat and a negotiating tactic to then be used at a later date. And I think the simple reality is that people didn't fully listen to or appreciate the rhetoric on the campaign trail and buy into it. And that's why the markets have been so shocked over the last 2 days.
China's fighting back tough, right? Imposing their own. Is this going to be an all-out trade war between the U.S. and China, U.S. and everyone? I mean, I know we don't know exactly how it's going to land, but the president has been pretty clear about liking tariffs and what he wants to do in terms of bringing manufacturing and factories and investments back to the United States.
I do think it will be a tit for tat for a while, but clearly this is part of a negotiating tactic to provide leverage towards a settlement and a negotiated settlement with the Chinese on the trade imbalances and where manufacturing takes place. I think it's really important when we kind of talk about reindustrialization. I heard some of your guests speaking about it before, and this kind of rhetoric that America can never reindustrialize or no economy has. We have to think of it differently. This is thoughtful, enlightened reindustrialization. There are certainly many parts of the supply chain and many products we can never realistically bring home, and it would be hugely, unenlightened to think so. But a lot can be, and some should be, and some must be. There are kind of buckets that we have to establish of things that should come home for national security reasons.
Like what?
Things that could be so some of these critical supply chains around, say, pharmaceuticals. China has threatened to use to kind of pull and use drug precursor supply chains as a way of putting leverage back on us. Things like critical minerals. Things where we simply have outsourced things that are too essential to our national security to not have them at least be in a kind of a friend-shored environment and hopefully in an onshore environment.
So in terms of investing opportunities, how do you play it, or do you kind of ride this out at this point and wait for the dust to settle? I'm just curious what you are thinking. You've got, a greater China growth ETF. It's been a global sell-off. It's not just the United States. So I'm just curious, what's your advice to investors at this point?
You don't sell today. I mean, you recognize, and you saw even the news trickling out that, already countries are coming forward to negotiate. Vietnam, who's a critical kind of supply chain component where a lot of the Chinese manufacturing fled after, kind of tariffs on China have gone. Those negotiations are opening up. Mexico and Canada are underway. So I would not sell today. If you could buy in and you were holding cash, I'm sure Warren Buffett's having a good time right now. But my recommendation is to sit tight and let these negotiations begin. And I think we know that this is a president who's highly transactional, who doesn't want to see the market in the red for any kind of a prolonged basis, and is therefore going to take actions vis-a-vis these trading relationships to improve these relationships improve the stock market, while also being very cautious of these critical areas that, again, have to be reshored or onshored.
I just want to end very briefly with the view that you have. Core Values has this America First approach, but you also have this China ETF. How does that work? Help me understand. It seems like that's in tension or in conflict.
So what we recognized with China was there were a lot of people shying away from the market for non-fundamental reasons. And so our view was to take a lens and look at Chinese investment opportunities through a lens of whether the companies that were in that basket were contravening American national security or American values. And so we filtered out names using former government officials to kind of eliminate those and essentially enable people to access the alpha of the Chinese market without feeling they were contravening American values. In tandem, as I mentioned before, we're launching other products that are around reshoring and reindustrialization with the U.S. So it's kind of a both sides of the equation opportunity, but the intention was to allow people to access China without feeling like they were contravening American national security.
Hey, Ben, thanks for joining us so late. Appreciate it. Though it looks like you're awake. You're like not, in your pajamas or anything. So
are you being driven around? We just want to know.
I am.
I knew it.
Okay, we don't have time.
We don't have
Next
time.
time you come on with us, we got to get the details of what you're doing up so late. But we appreciate you taking the time. Ben Harburg of Core Values Alpha joining us from Abu Dhabi.
Let's take a look at some stocks on the move today. A big day for markets. Bloomberg News cross-asset reporter Denitsa Sukova right here in studio. Tesla.
Let's start with Tesla. It's hard to find any green on the screen, but Tesla was down 10% today and down 40% year to date. Overall, we're in bear market for the NASDAQ 100. The Magnificent Seven is suffering, but Tesla is having a particularly hard day. First, we started with a downgrade from JP Morgan saying that the report we had about deliveries is confirming the unprecedented brand damage
that Wall Street feared, and that is in fact happening. We had reports about one of the few executives that are promoting the products along Elon Musk is leaving the company. He has been there for almost 13 years. So we have the tariffs. Obviously, in the beginning, Tesla was a winner from the tariffs, but now that narrative is emerging that they're not, because obviously a lot of the auto parts are not coming from the US. So that here where the tariffs come.
Okay, speaking of tariffs, 30 seconds on Nike.
Yeah, Nike was one of the biggest losers of the day until we heard that President Trump is negotiating with Vietnam. Now the stock closed 3% higher. This is no big relief. If we zoom out, it's down 24% year to date. We had the earnings report that was really not as strong. We have that big comeback. We have a lot of potential targeting women and all that. But the tariffs are really weighing on the stock despite the small relief today from the Vietnam news.
Just 2 names, but we could do so many. 489 names in the S&P 500 lower today. So there were a lot out there, 14 higher. Bloomberg News cross-asset reporter Denitsa Sokova, thank you so much. That's going to do it for us. Big week. Thanks to our team. Do not go anywhere. Balance of Power is next.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. Alongside Joe Matthew, I'm Kaylee Line.
Stocks plunged in the worst 2-day sell-off since March 2020, with retaliatory tariffs from China overshadowing a strong March payrolls report and the Fed chair signaling rates will stay on hold. We'll have analysis from Heather Boucher, formerly of the Biden White House Council of Economic Advisors.
President Trump extends the deadline for a TikTok sale by another 75 days as his administration works to finalize a deal. Senator Mark Warner of Virginia, the top Democrat on the Senate Intelligence Committee who helped lead the divest or ban charge, joins us with reaction.
And Republican Congressman Mike Lawler of New York also joins us this hour on the future of tax legislation as the Senate plans a vote-a-rama through the weekend to pass its new budget plan. Thanks for joining us on the late edition of Balance of Power on this Friday. A tough go on the markets. And joining us now with a recap of a day of turmoil on Wall Street is Bloomberg's Romaine Bostick in New York. Romaine?
Yeah, the superlatives are vast and many. An S&P 500 down almost 6% on the day, 9% on the week. The worst 2-day plunge for the index going back to the onset of the pandemic in March of 2020. And that's where most of the superlatives will take you. Unprecedented times with the S&P down 17% from its all-time high. The NASDAQ 100, which is all those big cap tech stocks, that's now in a bear market, meaning it's down more than 20% from its all-time high. You also had treasuries and the yen rallying. Those are safe haven bids. The idea that people are looking for some degree of safety to protect their money in the idea that there could be more turmoil. Equity option activity hit a record high on this day as people tried to position around that volume, at least as measured by the 3 main tapes that run across here in New York. There has not been a single day in modern history where we had more stocks swap hands. And I don't know if you can throw up the VIX at all. This is the main fear gauge. Basically, when people start to predict increase in volatility over the next 30 days, that goes up. That hit 45 at one point on the day, settled right around there. There's only been a couple of times in modern history, Joe and Kaylee, where it's exceeded that amount. And that was A, at the start of the pandemic, and B, back during the global financial crisis in 08, 09.
Incredible, the comparisons we're making. Bloomberg's Romaine Bostick, thank you so much for joining us. Now, against the backdrop of the market turmoil and this new tariff regime, Fed Chair Jerome Powell had to speak, and he made it clear that the central bank won't be rushing to react to the sweeping tariffs or to the financial market turmoil.
I will say, though, you know, it feels like we don't need to be in a hurry. It feels like we have time to, yes, it feels like we don't. No, I mean, it's like I said, you have inflation is going to be moving up and growth is going to be slowing, but it isn't really, to me, it's not clear at this time what the appropriate path for monetary policy will be.
Joining us now for more is Bloomberg's Mike McKee. So, Mike, at the same time he was saying we're not necessarily going anywhere anytime soon, he also was warning of potentially a persistent inflationary impact of these tariffs.
Yeah, basically, the Fed chairman came out and said stagflation is a very real possibility now, that the tariffs are going to produce worse outcomes than the Fed had even expected, and that they could see higher inflation and higher unemployment, which is a synonym for them for lower growth. And so the Fed would be put in a really bad position because there's no easy way out of that. Either direction they go will worsen the other one. So Jay Powell suggested that this is, we are facing some tough times ahead, probably, although he didn't go so far as to say this is actually going to happen. He said we have to wait and see what the impacts are on the economy as they develop.
Mike, I'm guessing Jay Powell would not have held that event today if he was in charge of the scheduling, the way this coincided with everything right now and the way the markets are churning. You spend more time around him than most. What did you think of the words he chose, the fact that he went where he went today, and his demeanor in public?
Well, I think it was very deliberate. He did not use the word transitory. He took that part back, said that prices may go up initially, and then he said they could continue to rise. So that's a complete change. But I think he took advantage of the opportunity to basically tell the markets there's no Fed put coming. As long as the markets are functioning, as long as there are buyers and sellers and they can transact business, the Fed is staying out of it. It's not their job to worry about tariff. It's not their job to worry about tax policy. It is their job to worry about inflation and growth. And he said, until we have to do something, we're likely to just sit here. So I think that's one reason we saw the final leg down today in the markets is those who were holding out for help from the Fed realize they're not going to get it.
Great to have Bloomberg's Michael McKee on a day like this. Mike, thank you so much. As we turn now to the White House, the politics behind all of this, the administration responding to the tariff fallout, and Bloomberg's Wendy Benjaminson with us at the table. Wendy, it's great to have you with us today. A lot of truth socialing today from President Trump. At one point, he said to the many investors coming into the U.S. and investing massive amounts of money, my policies will never change. Those are not the words that Wall Street wanted to hear today, I'm guessing, but he is standing by his guns.
He is, for now, he is absolutely standing by his guns. The question is, for how long will he stand by this? And, you know, there is no evidence yet that any investors are rushing to invest in the United States at all right now. They're all trying to figure out how to get through these tariffs and pass them on to the U.S. consumer. So that's, you know, the backdrop of this. But at some point, and the administration has fanned out Howard Lutnick and others, the Commerce Secretary and others, to go on TV and say, trust Trump, he knows what he's doing. This will all smooth out in a few days or weeks. But as my colleagues have noted here, that's not. No one seems to be trusting that will happen. So, you know, we've seen some reporting that at this moment, Trump just thinks he's right, that he's the one who can fix it, as he said in 2016, and that everyone else is wrong. At some point, he may find an elegant way out, or a way out that saves face, in which he can make deals. You know, yesterday he claimed the deals would only be phenomenal. He would only make a deal. Maybe those deals become a little less phenomenal if this market downturn keeps happening. So, you know, that's what we should watch, is where he starts to back off a little bit.
And just quickly on deals, he's still working on a TikTok deal, Wendy, today, extending the deadline another 75 days. The problem is, to get that done, he has to work with China, who just hit us back with tariffs of their own today.
Right. And he posted on Truth Social that they shouldn't have done that. And that was, bargaining from a weak position or something like that. But that's right. And so ByteDance has acknowledged, the parent company of TikTok has acknowledged that they are in talks, and Trump has said we're waiting for all the approvals. The question is whether China will now agree to this, or because this trade war has started between the two superpowers, whether this deal will go through. But right now, TikTok has 75 days to remain working in the United States.
All right, Wendy Benjaminson, thank you so much for joining us. And still ahead, we'll have more on the economic impact of Trump's tariff and that TikTok deadline extension with Democratic Senator Mark Warner of Virginia. He's next on Balance of Power on Bloomberg TV and radio.
If the tariffs remain in place and we have retaliatory tariffs, that is a very possible outcome. If we go into a recession, particularly a bad recession, 2026 in all likelihood politically would be a bloodbath. You would face a Democrat House, and you might even face a Democrat Senate.
Texas Republican Senator Ted Cruz on the Verdict with Ted Cruz podcast earlier today, issuing a warning on the potential political ramifications of President Trump's new tariffs. And joining us now for more on Bloomberg TV and radio is his Democratic colleague, Senator Mark Warner of Virginia, Vice Chair of the Senate Intelligence Committee and member of the Senate Banking and Finance Committees as well. Senator, welcome back to Balance of Power. If you're getting this kind of language out of your colleague, Senator Cruz, when Senator Chuck Grassley...
But on this one, you know, he nailed it.
I'm wondering if you agree with Senator Chuck Grassley as well, who is co-sponsoring legislation to require congressional approval for these tariffs. Do you get a sense that even a Republican-controlled Congress is getting ready to reclaim some Article 1 authority?
I sure hope so. It has been stunning to me. And listen, I've been criticized often for being too bipartisan, but I have been so frustrated by my Republican friends who've been so intimidated by the president to date that they have been just ceded power. And so taking back Article 1 power in terms of tariffs and the ability for Congress to have a voice, you know, candidly, the politicization of our intelligence community. One of the secondary stories of today was the firing last night of the head of the NSA, a 30-year career person, and about 10 other people from the National Security Council by some, you know, even beyond MAGA extremist, this Laura Loomer lady. And then we've got, obviously, these huge disruption in the markets taking place. And all that, as we get into tonight is one of the worst nights in the Senate. We have what's called vote-a-rama, because the Republican proposal to literally add $7 trillion to the debt, over a decade is going to be the first step of that is going to move through. So it is a triple whammy Friday.
Wow, you just touched on, I think, every topic we wanted to discuss with you this evening. Senator, I want to go back a couple of days to a news conference that you held outdoors on Capitol Hill. You introduced us to a local entrepreneur by the name of Bill Butcher. He's the founder of Port City Brewing Company in your hometown of Alexandria, Virginia. I talked to him a couple of days ago. Actually, it was just yesterday, no counting. He gets his malt from Canada. He gets his bottle caps from Mexico. He gets his kegs, made of steel, by the way, from Germany, and he just lost his bottler because everyone's trying to avoid making cans with tariffed aluminum right now. Here's what he had to say about the impact on his company.
We've never seen anything like this. And I was talking to our bottle supplier a couple of weeks ago, and he was explaining to me that he doesn't have an answer for us. He's been in the business for 35 years, and he said he's never seen anything like this either. There's a lot that goes into our supply chain, and it's just really been frustrating the past few weeks because our entire supply chain has been thrown into chaos.
Senator, we saw about a half dozen companies pull their plans for IPOs today because of what's going on around us. At what point do we go to the next level and someone like Bill Butcher, God forbid, is telling a story about going out of business?
Yeah, it's awful. And it's kind of like, this was totally predictable. I mean, if you listen to any economist, when you put on this level across the board tariffs, specific tariffs can be used as a tool, but not as an economic theory of the case. The last time I think we did this with Smoot-Hawley, and yes, America had a slight trade surplus, was the price was we ended up with the worst depression in our American history. And I just, I was with Bill. What was also with Bill the other day was we brought a guy from Richmond who makes bourbon, and he is basically seeing all his business dry up from Canada. And the fact is that, the Canadians rightfully are so angry at us that even if Trump were to pivot again, the bad feelings with our trading partners will be such that American products and goods, I think, are going to have a hard time reclaiming market share, even if Trump backs off.
Well, the Chinese don't seem to be too happy either, having slapped retaliatory tariffs on U.S. imports at a rate of 34% today. Senator, at the same time, we've learned that President Trump is extending the deadline to reach a deal for the divestiture of the U.S. operations of TikTok for another 75 days. Do you believe that China is going to be willing to acquiesce to that in this current environment? And frankly, if they get to keep the algorithm, is it in keeping with the law you and your colleagues fought so hard to pass?
Haley, thank you for bringing it. Let's get I know lots of other going on, but Donald Trump was the first guy that pointed out the problems with TikTok in about 2019. And I was reluctant to believe, but as chairman of the Intelligence Committee, I have seen the power of this app to be a propaganda tool that's frankly unmatched. Congress, 80% passed a law that says we don't want to get rid of TikTok, we just want to force a sale so the algorithm would end up in non-Chinese hands, a fairly low bar. I think the Biden administration, they should have pushed the negotiations quicker, but Trump gave what was partially illegal 75-day because the extension back on January 19th. We gave him the benefit of the doubt, but you adding this additional 75 days, that is completely against the law. And then, as you just pointed out, if they end up with a deal where the algorithm remains in Beijing, I got to tell you, I was a tech guy. I don't know how that would work. And I think the whole episode would be a scam. And I'm looking for my Republican friends who joined me in this effort to actually raise this concern. Our national security should not be used as a trading item in this tariff war. And that's what I was starting here. Well, you might lower the tariffs a little bit if China gave in. But I think when you mix the two, you have a recipe for disaster.
Well, in the spirit of national security and from your perch on the Intel Committee, Senator, I wonder your thoughts on what has become of the Signal group chat story. I know this is something you were very passionate about, and you got an earful from members of the military and their families on your recent visit to Hampton Roads about all of this. The White House says the case is closed. Will there be any recourse from the Intel Committee as you try to investigate this?
We've always been bipartisan. I've been urging the current chair to work with me on a solution. Luckily, the Armed Services Committee has launched a Inspector General investigation. That takes 6 to 9 months. The basic simple things like, has anybody collected the phones that these folks used and checked for malware? We now hear that there was not simply a single Signal chat, but there were 20 plus. What other classified information was out there? And as you mentioned, I was down in Hampton Roads, a heavy military area. These folks were rightfully pissed off because they knew if you'd been a military officer or a line officer for the CIA and you'd done this, you would be fired, no questions asked. And what it does is a double whammy. It both undermines the confidence and morale of our men and women in the military and the intelligence community, but it also makes our allies around the world reluctant to share information with us if we don't keep it classified. The Israelis in particular, has been in the public reporting, were particularly angry because they shared some of their best sources about Yemen. And they're saying, like, well, if you're not going to keep it secret, we're not sure we can share anymore. Those don't make America safer. So we ought to get, and I'm going to be offering an amendment tonight, we ought to get some basic accountability here.
Well, and the subject of what keeps Americans safe, you alluded to, Senator, earlier, the firing of NSC and NSA officials. What is the immediate impact on national security?
Well, what I'm fearful of is that these positions that have traditionally been non-political are going to be politicized. General Hawk, 30-year career military, thought he did a very good job. If he was being fired because this conspiracy theorist that thought that 9/11 was an inside job, that thought that school shootings were all staged, a normal White House would not let somebody like that within 100 yards of the White House. This crazy person was inside giving staffing advice. The president took it appears on General Hawk and the NSA and Cyber Command. They also took it on about 8 or 10 people who were on the National Security Council. And what is remarkable to me is many of the people who were on the National Security Council used to work for Republican House members or Republican senators. Will they speak up in defense of their former staff that they should not be fired? This is where it's all coming to a head. If our intelligence community becomes totally politicized, then and you have inability to speak truth to power, and clearly this is a White House that does not want to hear truth to power, then we are in extraordinarily dangerous realm.
Senator, it's great to have you back. We'd like to stay close with you on this. Democratic Senator Mark Warner of Virginia. Thanks for joining as always. Keeping with our focus on tariffs this evening, we spoke earlier today on the early edition of Balance of Power with Republican Congressman French Hill of Arkansas. He joined us in studio, spoke to the counting of tariff revenue.
In our discussions with our colleagues in the House, we've been thinking about the importance of extending the President Trump's tax cuts, cutting spending, trying to right-size government so that we don't have $2 trillion deficits. And we're not counting on tariff revenue because tariff revenue is very difficult to predict.
Let's bring his colleague from the House in New York, Republican Congressman Mike Lawler, into the conversation. Now, Congressman, it's great to see you. Thank you for joining us from World Headquarters in New York. Your thoughts on this now? There's a lot of noise out there, and you don't have to look far to start hearing about the market reaction to President Trump's tariff regime. Does the attention that this is taking and the money that it's costing in terms of market capital slow down the drive to extend or make permanent the Trump tax cuts? Is this making your job more complicated?
No, I think obviously short-term volatility in the market is a factor that we have to look at. But the reality is that all of the economic decisions that are in play is what we have to focus on, putting into effect. So, for instance, obviously the president has put forth his plan with respect to tariffs. The question on this is, short-term versus long-term. You're seeing already countries make determinations that they are going to reduce their tariff levels down, in effect, to zero. You're seeing foreign investment into the U.S. The question is, how long does the volatility in the market last with respect to the tariffs as the president seeks to negotiate with other countries? With respect to the tax bill, this is something obviously that we are in the process of working through with respect to reconciliation and making permanent the president's tax cuts. Part of this is making sure that we are offsetting the CBO cost affiliated with tax cuts with respect to savings in spending, as well as tariff revenue. As my colleague French Hill said, it's something that is going to have to be calculated, and so the CBO is going to have to provide that as we make that decision.
On one specific element of the tax code, you tweeted earlier today that $25,000 for the SALT cap, which Bloomberg has reported is a number up for discussion in these conversations, is, quote, woefully insufficient. Congressman, what number is it that you would find sufficient that you also think can get the requisite votes in your chamber?
Well, I introduced legislation that would lift the cap on SALT from $10,000 to $100,000 for individuals and $200,000 for married couples. We are in the process of negotiating. I spoke with the Speaker and Chairman Jason Smith earlier this week about the need to have that negotiation. I'm not sure, frankly, where the $25,000 number is coming from. Might be coming out of the Senate, but certainly not coming out of the House. Myself, my colleagues, Andrew Garbarino, Young Kim, Nick LaLota, those of us in the SALT caucus have been very clear that there needs to be a good faith negotiation. Because remember, if the Tax Cuts and Jobs Act expires, SALT comes back unlimited. The problem, of course, is that it would be associated with the largest tax increase ever. The alternative minimum tax would come back. So that's why we need to negotiate in good faith and come to a number that certainly will provide immediate tax relief to constituents like mine in Rockland and Westchester counties in New York, who pay among the highest property taxes in America. New York State, the highest tax state in the country. We have a lot of work to do here in New York, but from my vantage point, we need to lift the cap on SALT. It is an issue of double taxation and fairness, and I want to make sure that that gets done as part of any tax bill negotiation.
Well, Congressman, how confident are you in your ability of all of your colleagues to negotiate together if business of the House was held up this week by the Speaker trying to get rid of a discharge petition that you, of course, voted with the person who was presenting it, Anna Paulina Lula, around proxy voting for new parents? How does that get resolved when you return to Washington next week?
There's been a number of conversations over the last 48 hours. I'm confident it'll get worked out. But I'm confident in our ability to negotiate. President Trump has been extremely supportive on the issue of lifting the cap on salt. It's one of his priorities within the tax bill that he has laid out. So we will get there. Obviously, a negotiation takes time, but I think, given everything that is happening, getting a reconciliation bill done sooner than later is critical.
Can you get this done in time, Congressman, to include the debt ceiling? Because there is a concern that this might drag on for a while. You're trying to do a lot in what what the president likes to call one big, beautiful bill. If the clock is ticking here, can you get to the debt ceiling before the deadline? We're talking about something between August and September.
Yes, I think it's obviously paramount, and there's nothing like a good deadline to force folks to get to the table and negotiate a deal. And obviously having the debt ceiling deadline looming will force folks to compromise and ultimately get a bill across the finish line, which is what needs to happen.
All right, Congressman, thank you so much for joining us live from Bloomberg's World Headquarters in New York. That's Republican Congressman Mike Lawler of New York. Appreciate your time, sir. And still ahead, as tariffs continue to put pressure on the market, we'll discuss the anticipated economic impact with Heather Boushey, former Deputy Director of the White House Council of Economic Advisors, next on Balance of Power on Bloomberg TV and radio.
it really was kind of that Mike Tyson moment for crude oil this week, where everybody's got a plan until they get punched in the face. And really kind of that tariff announcement was the first kind of hit. And then the bigger hit that I think really kind of has shaken many investors is the decision by OPEC to not only unwind their production cuts, so they decided not to pause in the face of market weakness, but to accelerate the unwind.
Rebecca Babin, CIBC Private Wealth Senior Energy Trader on Bloomberg TV earlier today as oil prices sank to a 4-year low. And joining us now for more analysis here on Balance of Power on Bloomberg TV and radio is Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. So, Mike, if oil was punched in the face today, are we officially down for the count, or can we go lower still?
Lower still, Kaylee. Unfortunately, I've been called the perma bear in this space, partly because what happened with crude oil is when it pumps above the 100, it fueled what you're seeing now. It brought on that excess supply out of the U.S., and it shut down a lot of demand, as you see the proliferation of EVs come out of China. And now we're heading towards a normal cycle. So about the last 20 years, every time crude oil got above 100, it bottomed around 40, and maybe below that. We're heading there, particularly with the stock market going down. And remember, it's a stated goal of the Trump administration, and they have all the trends in their favor.
Wow. All right. $40 a barrel. What does that mean for gas when we're driving on 4th of July weekend this summer? And do oil companies keep pumping at that level? What happened to drill, baby, drill?
No, exactly. That's what it takes to shut off this excess supply versus demand. That's what's been happening in this country for 20 years. It's been growing, more supply, less demand. We need to export. But the key thing is July, we still have the summer season, but come July next year, $2 a barrel is my call at some point. I'm sorry, $2 a gallon is my call. It's not, the thing is, Joe, it's not obnoxious. It's a normal reciprocal dip to the rally. It's just what it always does. The question, are there fundamental forces to make it not do that? Yet I see the fundamental forces making it do what it normally does. It has to get cheap. You basically got to get commodities cheap to shut off that excess supply and demand, and crude oil is the most significant. I don't see what stops it, particularly if the stock market continues to drop a little bit.
Well, one commodity that's gotten a whole lot cheaper, Mike, is copper. If you thought the oil chart was bad, that chart actually looks a whole lot worse. Does it continue in this precipitous decline?
Yes, unfortunately. So the key thing about copper is I like to point out, I was an ex-trader, and sometimes I can see, I probably would have been stopped out on the way up and made a new high just recently, all-time new high at 537. Now it's down around 437. I think it goes down below 4, even lower. It's already at that price in London, and the U.S. is just catching up. So what we did is we squeezed out all the shorts for the wrong reasons, and the fundamentals of copper are just not good when the rest of the world is facing the tariffs from the U.S. and pressuring lower. And the key thing to think about copper, one thing I'll mention is bond yields in China, 1.72 10-year note versus a U.S. 10-year note, about 4%. That's severe deflationary forces from the most significant demand pull force in the world for commodities and copper. And they're heading to deflation, kind of what kicked off in Japan 20, maybe 30 years ago.
Mike, you've been great this week. We might need you next week. Mike McGlone of Bloomberg Intelligence with his view on the energy market. Today on the early edition of Balance of Power, we spent some time with Stephen Myron, the new chair of the White House Council of Economic Advisors in this Trump White House. Here's what he had to say about the current state of the market.
Of course, there's going to be some market volatility on the back of that. Of course, there's going to be some adjustments on the back of that. But on the end of it, things are going to be materially better. And I'll tell you why. Not only will the tariffs incent reindustrialization in America and companies coming back to build in America, but there's also two other legs to the stool that are of significant importance. There's the deregulatory agenda, and then there's the tax agenda. And both of those are profoundly stimulative for the economy.
For more on this, we turn to Heather Boucher, former member of the White House Council of Economic Advisors during the Biden administration. Heather, it's great to have you back on Bloomberg TV and radio. Markets speak for themselves today. And I walk back to when you first came into the White House with Joe Biden as president. And the question every day was, when does the recession start? You had multiple predictions of recessions over that 4 years. We're looking at JP Morgan since we came in today, saying it now projects a U.S. recession in 2025, having already increased the odds. Do you believe that to be true?
Well, certainly there's, I think, a lot of concern that is true, a lot of concern about what's going on with this economy. We went through so much in an economy that was actually so good, that was delivering jobs and wage increases for people around the country. And yet this president has seen, already, and it's not even been 100 days yet, this collapse in the stock market, due to this very chaotic and arbitrary tariff policy that he's put into play. And this is not good for the U.S. economy, and I wouldn't be surprised if it didn't continue to pull it downwards. I still continue to hope that something will shift the balance here, that maybe we will get some sane policy. But I think what is so disturbing about it is that this policy that he announced, the president announced this week on tariffs, is going to raise prices on a lot of different things coming into the United States, but in a haphazard way. There's no real logic to it. And it doesn't make sense for, as the CEA chair, as you just said, in terms of a plan to boost U.S. competitiveness in manufacturing. We did that over the past few years in the Biden administration. We saw a historic run-up in the construction of new manufacturing plants all across the country. After, in the President Trump's first term, he did not see that, even though he did tariffs. I don't see how you see that kind of growth with this kind of economy and with this kind of haphazard economic policy.
Well, so to that point, Heather, there are arguments that the deregulatory and tax relief efforts that will come later are going to help juice the economy. Is it so much that those ideas in and of themselves aren't going to have the economic impact they think it will, or they can't have the economic impact soon enough to offset the more immediate effects of tariffs being implemented like this?
Well, making this, so if we accept the goal that they want to make a significant structural shift in the U.S. economy to make more here in America, there's a lot of different policies that they would need to do to make that happen. How do you support investment all across the country? While we are having this conversation about tariffs, President Trump has allowed Elon Musk to take this chainsaw to the federal government, cutting back on all sorts of programs that make it easier for firms to invest around the country, make it possible for communities to do what they need to do to make that investment possible and viable and effective in communities around the country. So I think I take issue with the idea that just deregulation is going to solve the problem. You actually need government to be effective around the country to help make that investment possible. And then let's talk about these tax cuts. I continue to think that all of this is a distraction relative to the massive tax cuts that look like they're now closer to $5 trillion that the Senate has been working on this week, the Republicans. And these tax cuts that they are putting into play are going to, again, give massive benefits to those at the very top of the income distribution, not helping typical Americans, not helping U.S. manufacturing workers. And at the same time, they're going to mean cuts in basic services for Americans, cuts in access to healthcare, cuts in access to education, the kinds of things that help improve our human capital, improve our communities, and make those investments that we want to see in communities across the country viable. And not, let alone what it's going to mean for families and workers all across the country. So it does seem like the number one goal here is to give the rich as many tax cuts as we can, but that is not going to create the kind of growth that the president claims. It didn't in his first term, and now he's doubling down on these failed economic policies.
Heather, I'm sure that you're watching some of the front running that's taking place before tariffs taking effect. And by the way, they will start kicking in at midnight here, whether it's cars or home appliances or even imported wine. Consumers have been very busy. Can you paint the picture for us of what the consumer will be doing? How much money will be left in the second half of the year?
Well, consumers are going to get hit hard. And, I worry that especially consumers that are more income constrained, where they don't have a choice about when to make their purchases, workers and families at the lower end of the income distribution are going to be hit especially hard. Of course, one of the first things that's going to happen is grocery prices, fruits and vegetables that we import from overseas. Those costs are going to go up. And then we're going to see the cost of everything go up because tariffs are now on everything, whether we can or already do make it here in the United States. And that's going to create, people are going to hold back on spending. They're going to have to spend more, and that's going to leave less money left over for all the other things that they want to do in their lives. So, and at the same time, of course, because of all of these cutbacks that, Elon Musk chainsaw is doing to the federal government, there's millions of people who actually are now going to need to spend more money, more of their own money on healthcare or education, and they're not going to have the resources for that. I mean, this is really an impoverishment of Americans all across the country without a clear plan to deliver benefits for communities and for workers and for industrialization. This is what I find so challenging to believe, that the president is asking the American family to accept this pain with no clear plan for any long-term gain.
Well, and speaking of things that are challenging, Heather, we heard from the chairman of the Federal Reserve today indicating that he's not in a rush to change policy, but keeping in mind they have a dual mandate here. It strikes me that we are talking about both an inflationary risk and a growth risk at the same time. They cannot respond to both of those things simultaneously, right? So if it all comes down to it, now that you're outside the White House and can weigh in on this, which side do you think they ultimately choose?
Well, the Federal Reserve is in a real bind right now because they continue to want to get inflation down. And of course, what's happened over the past few months is, as President Trump has implemented his policies and people have seen what that really looks like, consumers have lost confidence in the economy and they now expect prices to be higher far into the future. That is exactly where the Fed didn't want to be. They didn't want to have to worry about those longer term expectations solidifying into higher prices. That's going to make it harder for them to contain inflation, while at the same time, they're very worried about economic growth. We have this massive shock to the economy. I mean, quite frankly, let's be clear, we have not seen anything like this, certainly in my professional career, in my lifetime, where the president causes this kind of economic slowdown in the economy, and the Fed is struggling to figure out how to cope with it. But I really do worry that we are going to see that kind of stagflation that we saw in previous eras loom its head, and it does not need to be that way. Let me add one more thing. Today, of course, is the day that we got new data on unemployment and jobs. And of course, that data looked pretty good. But let's remember, that data is very backward looking. And the thing that we know about the labor market is it's always a lagging indicator. So it can take some time for economic turmoil to show up in hiring and in people being laid off. And so we need to be watching that over the next few months and not really take a lot of solace in this month's numbers.
All right, Heather Boushey, former member of the White House Council of Economic Advisors under the Biden administration. Thank you so much for joining us. And still ahead, our political panel gets their chance to weigh in on Trump's tariffs. They'll join us next on Balance of Power on Bloomberg TV and Radio.
That list, I'd like to know who actually created that list. For example, they listed the Heard and McDonald Islands, which of course have no human habitation, has penguins. What are you going to do? Are you going to sort of, tear up the penguins?
Andrew Hale of the Heritage Foundation last night on Balance of Power, talking about some of the more unlikely targets of President Trump's new tariffs. A moment of levity in a week that in a lot of ways has been pretty rough, especially if you're invested in these equity markets. And joining us now with their reaction to these tariffs and the fallout from it is this evening's political panel. Lester Munson, co-head of the international practice at BGR Group and Republican strategist, alongside Democratic analyst and Bloomberg Politics contributor Jeannie Sheehan Zaino, political science professor at Iona University. So Lester, the Penguins, I would imagine, are not invested. So they have been immune to some of this week, even if they're going to have to start paying tariffs with their pebbles. But when you look at a week like this one and the messaging we are getting from the administration, as bad as the market's seen, they say everything is going to be okay in the long run. Are they missing the moment here?
Well, I hope they're not. I hope they're right. I hope that this does balance out. All evidence seems to be to the contrary. To be clear, there's not really a coherent economic theory that leads to us thinking this is going to be successful. So I hope the president is kind of building in some flexibility here to adjust to the very real market realities that we've all seen play out for the last couple of days. This is a tough situation. We should give him a little bit of time. I think is not unreasonable to give him a little bit of time. I don't want to overreact today. It's just really been a few hours, a couple of days. But we should hope that the president has the flexibility here to pivot to something that is going to work over the long run.
Jeannie, JP Morgan says there will be a recession in 2025. And we're hearing the R word a lot. We're hearing the S word a lot. Won't say it on TV. What are the politics of these markets for Donald Trump?
Well, Donald Trump himself, when running for president in 2024, said that inflation and recession kill presidencies. And he was describing, of course, Joe Biden's presidency. And now he has come in and within 3 months, he has managed to rock the stock market. He has managed to put through the most regressive tax we have seen. He has managed to tell people in a very callous way that he doesn't care if they have to pay more for their cars. I mean, the list goes on and people are suffering. So while I agree with Lester, we don't want to overreact, I don't think it is a overreaction to say this is a self-inflicted wound. And at this point, I don't think our focus should be as much on the president, but on Congress. There's a reason they are the first branch of government. Stand up. You have the power to regulate commerce and regulate it. One person shouldn't have the power to do this under a faux Emergency Powers Act in the United States, and that's what we're seeing.
Well, with that in mind, Lester, the president doesn't have to stand for re-election again, or at least he's constitutionally barred from doing so even if he wanted to. That is not true for Republicans who currently control Capitol Hill. It's ultimately them that provide the pushback to this.
Right, and we're already starting to see it. Ted Cruz has kind of come out and said there are going to be implications for this potentially in the elections next year. We saw Chuck Grassley move with Senator Cantwell to start to pull some of this this policy responsibility back to Congress, which Congress was happy to give to the president back during the early days of the Cold War as a way to respond to that very real crisis. It's a different time. Can Congress do that realistically today? I don't think so. But it is nice to see these members who are no squishes, if you will, starting to talk that way, that it's time to start to rethink how this power is distributed.
If the White House called BGR brought you in for some advice here, would you be urging them to look for off-ramps this weekend?
I don't know if I'd phrase it that way. I think I would praise the president for his leadership, for his leadership and his willingness to take a tough stand. And I would talk about all the examples of him flexing to a new reality once he kind of saw what the immediate consequences were. And I would talk about how he does a really good job of not being too ideological about things and being a very pragmatic president and doing the thing that is actually best for our economy.
So yes, is your answer. Got it. Okay.
Well, but isn't there still a chance, if you judge his conversation with Vietnam today about lowering their tariff barriers, Jeannie, that at least in some sense, he is able to achieve his objectives here and can work the art of the deal?
Yeah, I mean, the reality is we've heard mixed messages from the president and the administration on what he is doing this for. And if it is truly to negotiate, you would think he wouldn't do it. across as many countries and to the extent he has. But if it is not to negotiate, then what is he doing this for? Is he looking to bring back manufacturing to the United States? They have to be clear on the goal, and they need to minimize pain, short and long term, in fulfilling these policies. And I know what I would tell the president if he called me this weekend, which sadly he won't. I would tell him to watch Ferris Bueller's Day Off. Remember that old movie where Ben Stein yes, he says, what happened when Republicans did this in the 30s? It didn't work, and the Depression continued. So it's a lesson. Maybe the president needs to sit down with some Ben Stein and review that. That's a good little piece of film.
Well, park your voodoo economics right here for a boy from Chicago. I'm sure that means a lot to you. Lester, if we pick up here where we left off on Monday on Wall Street, another 1,000, another 2,000 points, what will be the political calculation at the White House?
Well, I think we will see things start to shift, and we're going to hear more senators and more members of Congress talk about how there needs to be some flexibility, and we need to be thinking about how this is impacting the average American, because this is not just happening to elites. Actually, at the end of the day, the elites, this is kind of the conversation on Twitter, right? This is bad for elites and good for the working man. That's not really true. The elites are going to be fine regardless of what the policy is. It's the damaging impact on the middle class and the working class that we're probably going to start to see next week if things continue to play out this way. And then I think the White House will respond.
Jeannie, we're out of time, but do you think the sun comes out tomorrow?
I do think it will, Kaylee, and I hope you are ready to have a nice weekend and watch Ferris Bueller again.
Okay. Ending with a little optimism,
So
Joe.
much optimism. Yeah. Now I've got to go watch the movie. Lester Munson, Jeannie Shanzano, great to see you both. Thank you for the humor. We kind of needed that today. Coming up, the Senate preparing for vote-a-ramas this weekend. Tariffs are set to go into effect at midnight. This is real. We'll look ahead to what's next in Washington. Coming up next on Balance of Power on Bloomberg TV and radio. It's Balance of Power on Bloomberg TV and radio alongside Kaylee Lines. I'm Joe Matthew. Thanks for spending some time with us on this Friday. We're not done yet. Senate Republicans will begin voting tonight on a new budget framework to clear the decks for a massive domestic policy bill. There have been criticisms from hardline conservatives, moderates, Democrats. We talk about it every day here. This is on the way to reconciliation. But first must come vote-a-rama. So time to bring in the takeout and the wine. But that's not the only thing happening tonight.
No, in fact, 6 hours from now, or just about at midnight, is when the tariffs take effect. This is the first base level tariff, 10% on all U.S. trading partners. Of course, that is just round one. Next week, on April 9th, is when the reciprocal levies go on top of that.
That's right. We'll see how the markets behave between now and then. And that's why we have a special program lined up for you on Sunday night.
Indeed. Make sure to tune in Sunday evening, 5 p.m. Eastern time for a Bloomberg surveillance special as we look for coverage of how futures will be opening after a brutal week on Wall Street. Everybody take a breath, enjoy the weekend. We'll see you back here on Monday. This is Bloomberg TV and Radio.
This has not been a great time for genius. The people who claim to have it do not seem to qualify for it. The people who diagnose it and others seem to have a very, very narrow definition in mind. And the people we can all agree are stone cold geniuses always seem to have a dark side. I read in Bloomberg Businessweek about the biggest crypto genius of them all, Sam Bankman-Fried. At his peak, he was worth like $26 billion. And that was before he was accused of running one of the biggest frauds in American history. His defense is that he is not a criminal, essentially, just inept. What does it mean to have genius in work, in the marketplace, in life? And who is even to say? To make anything simple takes actual genius, and we're going to try to live up to that name together tonight. It's the Business Week Show. Hello, I am Max Abelson, and I'm not a genius, just a regular, like slightly above average journalist who has spent about the last decade and a half here at Bloomberg News and sometimes our magazine, Bloomberg Businessweek, writing about Wall Street's money and power. And what that means is I write about ambition and ownership and imagination and survival and risk and second acts and, of course, genius. Tonight and in the weeks to come, we are going to be talking about those things at this table with people whose lives and careers and ideas are big or interesting or just really fun. So, welcome. This is the Business Week Show, and it's starting right now. If you consider yourself a master of Wall Street, a connoisseur of investing, a soothsaying financial genius, a brilliant portfolio manager, our guest has very bad news for you. Burt Malkiel's book, A Random Walk Down Wall Street, 50 years ago, had a clear and vivid message, which was that Wall Street genius is really just an illusion, and that professionals in pinstripe suits at the end of the day are no better than naked animals. It was a genius and radical idea because what he had to say is that you should forget them and just buy and hold clear, boring, basic, low-cost index funds. He is here to tell us about it. Burt Malkiel, welcome to the show.
Thank you very much. Glad to be here.
Your book is actually, it's pretty funny. It's a little saucy sometimes, your book. I mean, you say no one in finance can really forecast the future, or at least they can't do it successfully, consistently. You know, I think you use the word genius in quotation marks, and you give it to Ponzi schemers and whatnot. Right now, are there any actual individual geniuses on Wall Street? You know, real human geniuses, maybe AI is a genius we've been all waiting for. Can you identify any current geniuses on Wall Street right now?
Well, as you know, I put genius in quotes because I'm not sure there are geniuses in the market. And I've always said I would much rather be lucky than smart. Are there some hedge fund people who have, in fact, made a lot of money? George Soros bet against the British pound and made a lot of money. There were people who sold short in 2000 and made a lot of money. But I am not willing to say that they were geniuses. I want to say that they were lucky, because for every one of them, there was a hedge fund that in fact lost money. No, I don't think there are geniuses. I think there are a lot of very smart people in Wall Street, but it is not possible to predict the future. And, you know, it's kind of very interesting how you talk about AI. I recently had to give a presentation on the economic outlook. And I thought, you know, just for kicks, I will go to ChatGPT and I will ask, can you give me an outline of what I should say? And actually, ChatGPT gave me a wonderful answer. It was a one-sentence answer. I cannot predict the future.
It might not necessarily qualify as genius, but you're able to write about Wall Street with clarity. which is really unusual because Wall Street, and I suffer from this myself, you speak to Wall Street executives and they absolutely fetishize complexity. Why does Wall Street like to make things sound so complicated? Is there something sinister or something that has to do with the ego?
Whether it's sinister, but this is a very highly paid profession. And someone like me who says, listen, don't listen to anybody. Just buy a simple index fund and keep on investing period after period. If I'm charging you 2% a year to manage your money, I want you to think you can't do it yourself. So sure, you've got a vested interest. This is a very highly paid profession. And these guys do very, very well. Is that sinister? I don't know. You call it sinister, anything you want, but is there an incentive to make it seem like it's very complicated, that ordinary people can't do it themselves? I think that's absolutely right.
The honest truth is, it's not necessarily that I think that the aura of complexity on Wall Street is coming from a sinister place. More like it makes me feel bad or makes me feel dumb. And that I appreciate that your book is sort of written so that I can understand it. But it does make me think about exclusion in a small way, because so many stocks are owned by so few people in this country, because the very wealthiest people in America have such giant portfolios, that when the stock market goes up, inequality goes up too. Is there anything that can be done to change that in the future?
One of the things that's impressed me throughout my life is really how capable so many people are. And I think to the extent that we can eliminate discrimination, I mean, for example, opening up our jobs, our economic opportunities to women has been a very good thing, and I think has been generally helpful for women. I think it's the same sort of thing in terms of racial discrimination. I am absolutely convinced that rather than there being just a small coterie of geniuses, that intelligence is very widely distributed in our population. And so my own sense would be the more we can do with education, the better.
Why is it that we need geniuses, or really just the concept of genius? Is it like the way we need heroes and heroism, to help just explain the world and justify?
I think we need innovators, and I'm not saying that innovation isn't good. We absolutely do, but I'm not going to call them geniuses. And Jack Bogle would certainly never have called himself a genius. But I think we do need innovators. There will undoubtedly be financial products that are actually good for one. I'm not a fan of Bitcoin. I don't think, I don't recommend that any investor buy it. But will there be improvements in the payment system in the future? And will there be digital currencies in the future that are stable and that are useful, as opposed to something that goes up $1,000 or down $1,000 in a day? Absolutely. And there's room for much more innovation in finance. So I think there will be innovation. There should be innovation. I just wouldn't call it genius.
That was great. Burt Malkiel, thank you so much.
Thank you so much. I really enjoyed our conversation.
Stay tuned, because next we have a very far out genius. There is no one way to be a genius. You could be dreamy and far out. You could be scrupulous and scientific. You could work within the institutional establishment, or you could honor indigenous wisdom. All of those descriptions apply to this guest. Moraba Jah is a space environmentalist, an astrodynamicist, a spacecraft navigator, and the first African-American professor of aerospace engineering at the University of Texas. Last year, the MacArthur Foundation gave him a fellowship that is informally known as a Genius Grant. So if you want, you could call him a genius, you could call him Professor Jah, but you'd rather you call him Moraba. So, Moraba, welcome.
Great to be here, my brother. Thank you so much.
Really glad to have you. I really love the phrase, a stroke of genius. You were in Alaska with your family in a hotel one morning. I think you were taking a shower.
Yeah.
And you had this feeling and this vision that kind of struck you. And you know, whether or not it has anything at all to do with genius, tell us about that moment.
You know, I'm in the shower, and I felt a presence. And in my mind's eye, I saw flashes of scenes from like history and how in the beginning, whatever that means, it seems like there was this intergenerational contract of stewardship with the planet, but that humanity over time has mostly abandoned that intergenerational contract of stewardship and has forgotten about how interconnected things are.
Did that moment change the life you led and the work that you do?
Absolutely. So one of the people that I really look up to is Jane Goodall. I watched something about Jane where she said that she went to a meeting as a scientist and she left that meeting an activist. In very similar ways, I went to Anchorage kind of just this scientist, and I came back both a scientist and now this space environmentalist activist to really try to, I guess, really showcase how we need to protect orbital space.
If there's a kind of genius that means something to you, something that you would want to live up to, or something you'd want to recognize in yourself, what would that kind of genius like actually look like?
To me, the best kind of genius is simply allowing myself to let the universe go through me and I guess use me as some sort of vehicle for the work that I'm trying to do. And if I can keep myself kind of in the moment and in a place of compassion and empathy, then I think genius is just what comes through when you allow that to happen.
There's more garbage orbiting the Earth than there are working satellites. You now work not just to make sure that all that stuff is properly tracked, but to be an evangelist for expanding the way we think about environmental protection so that it includes all that stuff. What can those of us who are not scientists, what can we do to help you?
Every day, the technologies that we have are more and more reliant on these robots in the space that we call satellites. And we're tracking about 50,000 things ranging in size from a cell phone to the space station. 5,000 are working and everything else is garbage. So that's like 90% of the stuff is trash. The thing that most people just don't realize is that these satellites that are providing these critical services and capabilities, position, navigation, timing, communications, internet with the Starlink satellites, right? Any of these things can get schwacked, that's the technical term, get schwacked by a piece of junk, and that's game over, and then you lose that capability. So I think more and more people just need to be aware that, oh, well, that space, that's somebody else's problem. No, it's our problem because our way of life, our technology is now going through this infrastructure.
There's a real stereotypical idea of genius that I'm thinking of a kind of solitary genius working by herself or himself off in a fun cabin, you know? What does it mean? What would it mean to be a genius collaborator?
Back in the times of like the Renaissance, people looked at folks like, Da Vinci, Michelangelo, and they said, okay, these are geniuses in their own right, right? And people say, well, how can anybody be like another one of those? Science has developed so much beyond those days that there's no way for somebody to be able to be, quote unquote, this Renaissance person that knows very deeply things in all these different fields. Like those days are gone, okay? But to me, the real genius is recognizing where you bring in smart people from other fields that complement and augment your own to solve ways.
Yeah, with one another. But my understanding, though, from reading a little bit of your writing, is that you were, I think in your childhood, you felt really isolated.
I did, yeah. My mom was born in Haiti, and she was naturalized citizen. My father, Sierra Leone, naturalized citizen. They got divorced when I was very young, and my father was just very abusive. So at the age of 7, he kidnapped me, and 9 days later, they found me in some apartment in the Bay Area, put me back on a plane to my mom. And my mom had, we had a cousin that lived in Caracas, and so we fled the country because my mom's like, I don't want your father to ever find you again. He never did physically again. But growing up in Venezuela, I felt very isolated. I felt very alone. I came into contact in this void with what seemed to feel like an ocean of infinite love and compassion. And then I realized, I have a choice here. I can choose to meet my experiences with equal anger, or I can choose to act from a place of love and compassion and heal from my pain and make my healing be of service to others. And that's what I've chosen to do.
When the MacArthur Foundation, when they named you a fellow, they said it was because, they used a beautiful phrase, it's because you envision transparent and collaborative solutions for the Earth's orbital spheres. What are those solutions? And maybe when are they coming?
My inspiration for this comes from indigenous people, from traditional ecological knowledge, TEK, I call it ancient tech. And so for me, the vision of my future is seeing Western science and traditional ecological knowledge come together, not annihilate each other, but actually harmonize. And that could be the way of the future, so that humanity does recognize interconnectedness.
you.